Okay, welcome to JK Shah classes. Today we are going to discuss RTP, revision test paper for May 2022 attempt for CA final. Now this RTP is based on provisions of Finance Act 2021. Now Finance Act 2021, 70-80% of the amendments are applicable retrospectively from AY 21-22. Only 25-30% amendments are applicable from AY 22-23. Most of the questions of this RTP comprises of 25 questions. Out of these 25, almost all of them are based on various latest amendments. So I would suggest that you first please be ready or glance through all the amendments applicable for your May 2022 attempt of CA final. Then you will have a better understanding of the provisions or better understanding of these questions. This RTP comprises of 25 questions. Out of 25 questions, first question is case scenario 1. Second is again case scenario 2. Now case scenario 1 and case scenario 2 comprise of MCQs 1, 2, 3, 4, 5. First 5 MCQs are case study based or case scenario based. Then MCQ number 6 till MCQ number 10. Next 5 questions are based on case scenario 2. So 5 plus 5, 10 questions are done out of 25. Then question number 11 till question number 15, these 5 are loose MCQs. And then question number 16 till question number 25, the last question, these next 10 questions are full-fledged descriptive questions involving applicability of the various provisions, or you can say practical questions, including DTAA, minimum alternate tax, assessment of public charitable trust, etc. We'll be discussing. Now these case scenario 1, all of them are based on latest provisions. Case scenario 1 is very lengthy. It is based on provisions of section 9B and section 45(4) capital gain chapter. So I would suggest that before you start with this video, please glance through all the provisions. Also, I would recommend that in order to save time, before we start solving the question, you please read the question by yourself once. Pause the video, read the question, then only you proceed further. You'll have a better understanding. So without wasting time, let's start with case scenario 1. Case scenario 1 is based on, as I suggested, as I told you, it is based on section 9B, which is newly introduced by Finance Act 21 but applicable from AY 21-22, pertaining to dissolution or reconstitution of partnership firm, LLP, AOP, BOI, etc. Now case scenario 1. Mr. Prem, so I'll read a little faster in case you want to read and understand properly. You are taking time to read, then please pause the video, finish reading the question by yourself. This instruction is applicable for all the 25 questions. Mr. Prem is a partner in 2 firms, X and Company Mumbai and Y and Company Delhi. Okay, now here what is happening is, in one of the firms, out of 2 firms, in one of the firm there is a reconstitution and in one of the firm there is dissolution. Whenever there is reconstitution, I would write here, whenever there is only reconstitution, whenever there is reconstitution, and whenever there is dissolution. Whenever there is dissolution, what will happen? Only section 9B will apply, and whenever there is a reconstitution of partnership firm, section 9B along with section 45(4) will be applicable. And whenever 45(4) applies, in future there will be 48 clause 3 also applicable, read with rule 8AB. Rule 8AB. Now in case you want to find what are the provisions applicable, you can refer to my latest amendment sheet, which is again uploaded on YouTube on JK Shah classes channel. So whenever there is a dissolution of partnership firm, only section 9B will apply, and whenever there is a reconstitution, 9B plus 45(4) both will be applicable. So please glance through the provision. Okay, starting with the question, Mr. Prem is a partner in 2 firms, X and Company Mumbai, Y and Company Delhi. X and Company has got 4 partners, okay, including Prem, who share profits and losses equally, underline equally. So X and Company has got 4 partners. Prem resigned from X and Company, that means there is a reconstitution, and whenever there is a reconstitution upon retirement or death of one of the partner, it will be called as reconstitution. This is happening on 1st April 2021. On the said date, capital balance of each of the partners stood at 32 lakhs. 4 partners, each partner 32 lakhs. In order to settle the dues of Mr. Prem, the firm revalues its land for the first time since purchase. That means there has not been any revaluation in past. The valuer also valued self-generated goodwill at 70 lakh rupees. Self-generated goodwill, cost of acquisition will be nil, though it is valued at 70 lakhs. That means 70 lakhs is the value as on 1st April 21. The firm has following capital assets whose details are as follows. Firm, if you can see, there are three lands, land at Pune, Nagpur and Mumbai, and then self-generated goodwill. These lands were acquired in 2013, 2015, 2013. So that means all the three lands are long-term. Why? Period of holding is more than 2 years. That is 24 months. Cost of acquisition 15 lakh, 25.4 lakh and 88 lakhs. And value as on 1st April 21, FMV. We will have to take into account FMV for the purpose of section 9B as well as for the purpose of section 45.4. Okay, the market value is 50 lakhs, 45 lakhs, 250 lakhs and self-generated goodwill is 70 lakhs. Okay. April 2021 XN company. Right now details are given for XN company which has 4 partners including Prem. April 2021 XN company gave land at Nagpur, this particular land which was costing 25.4 lakh with market value 45 lakh and 15 lakh rupees of money. So 45 lakh is the market value of land, 15 lakh is the money given to him, to Mr. Prem. Total 60 lakh worth of things are given to Mr. Prem because he is resigning to settle his capital balance. Okay, then there is a story of YN company, firm YN company dissolved. Okay, so YN company is getting dissolved on 1st March 22 in the same year, financial year 21-22. XN company, there is a reconstitution. Reconstitution 9B and 45.4 both will be applicable, and in case of YN company there is a dissolution, and since there is a dissolution only section 9B will be applicable. 45.4 will not apply in case of YN company. And it distributed its land at Chandigarh, Mohali and Gurgaon on the same date to its 3 partners. XN company has got 4 partners. We already checked it out. Here it was given 4 partners. And in case of YN company, there are 3 partners. Prem, Akshay, Arav respectively, who share profits and losses equally, underline equally. So both the firms, profits and losses are shared equally. But if you observe, XN company has got 4 partners and YN company has got 3 partners. These are the details. Okay, we would be needing the details for 45.4 and 9B. Okay, particulars of these lands are given as under. Now what is happening is YN company is getting dissolved. So I'm just drawing a line here just to distinguish between XN company and YN company. XN company has got 4 partners including Prem. YN company has got 3 partners. Profit sharing ratio is equal in case of both the firms. Okay, 3 lands are distributed amongst 3 partners. Which land is given to which partner? So it is saying respectively. That means Chandigarh land is given to Prem, Mohali land is given to Akshay and Gurgaon land is given to Arav respectively. Okay, land at Chandigarh given to Prem, land at Mohali given to Akshay, land at Gurgaon given to Arav. Date of purchase is 2011, 15, 11. That means all the 3 lands are long term. Cost of acquisition was 18.4, 15.24 and 16.7 lakh respectively. FMV on 1st March 22 as on the date of dissolution was 62, 59 and 70 lakhs respectively. What has been asked to us? These are the details given. So primarily you have got XN company, 4 partners, 3 lands and self-generated goodwill. YN company, 3 partners sharing profits losses equally, 3 lands. Both the firms have got 3 lands, but XN company has got 1 extra asset, self-generated goodwill. Okay, in addition, okay, so 3 lands are given by YN company to 3 partners, Chandigarh, Mohali, Gurgaon. Prem, in addition, Prem and Akshay were being given money of 8 lakhs and 11 lakhs respectively on 1st March 2022. Okay, CII numbers are given to us for various years. First question, on the basis of facts given, solve the following based on provisions of Income Tax Act. First is, what would be the amount taxable under section 9B? Now here 9B is going to be applicable for both the firms. Understand, whenever there is dissolution, 9B applies. We know pretty well. Whenever there is a reconstitution, 9B and 45(4) both get attracted. That means section 9B is always going to be attracted, whether there is a reconstitution or there is a dissolution. Okay. So what is the question? Question is, what would be the amount taxable under section 9B in the hands of XN company and YN company for AY 22-23? This is going to be one of the lengthiest question. This question Institute has drafted very nicely, covering entire provision of section 9B, 45(4), rule 8AB, rule 8AA, sub rule 5 and section 48 clause 3. One by one we'll be discussing what would be the amount taxable under 9B. So in order to calculate 9B, let's first start with YN company. YN company would be very simple, but here all the three lands for XN company as well as for YN company, the lands are going to be long term. Therefore, indexation will be required. So let's start with XN company rather. So for XN company, let me write question number 1, section 9B, XN company. Now XN company, what have they given? How to calculate 9B? Section 9B, either capital asset is transferred or stock in trade is transferred, or both are transferred by specified entity, that is firm, AOP, BOI, to its partners or members. Capital asset is transferred, then its calculation is very simple. Whatever capital asset is transferred, find out market value. FMV will be the sale consideration minus cost of acquisition or index cost of acquisition. Differential amount will be long term or short term capital gain. 9B is very simple. If stock in trade is transferred, then indexation is out of question. It will be taxable under the PGBP if stock in trade is transferred, but in this question there is no stock in trade. Here only capital asset is transferred, so it will be taxable under the capital gain. We know about it. So which asset is transferred by XN company? XN company has transferred land at Nagpur. This particular land, FMV is 45 lakh. And then money is transferred, but money does not come in the picture for the purpose of section 9B. 9B only two assets, capital asset, stock in trade. Money will be taken into account for the purpose of section 45(4), not for 9B. So simply land at Nagpur, what will happen is sale consideration, full value of sale consideration will be equal to its FMV. FMV is 45 lakhs. Minus index cost of acquisition, because all the lands in the question are long term. What was the cost of acquisition? Market value is 45 lakh, cost of acquisition was 25.4, but acquired in 2015. So 2015 April, that is financial year 15-16. 15-16 ka index number 15-16 is 254. 254, so it will be 25.4. and current year it is 317. 25.4 the cost of acquisition, 25.4 lakh multiplied by 317 divided by how much was it? 254, right? 254 index number divided by 254, how much would that be? So it will be 25.4 multiplied by 317 divided by 254. 31.7 lakh. 31.7 is index cost of acquisition. Differential amount 13.3 will be the capital gain. But which one will it be, long term or short term? It will be long term capital gain under section 9B. So for XN company, 9B is done, 13.3. Now coming to YN company. You have been asked to calculate for YN company also. What is YN company giving to Prem? YN company, there is only dissolution. There is no reconstitution. YN company is giving to Prem land at Chandigarh, which was acquired in 2011 long term. 18.4 is the cost of acquisition, 62 lakh is the fair market value. However, in case of YN company, lands are given to three partners. It's not only Prem. So as far as applicability of section 9B for YN company is concerned, we'll have to take into account all the three lands. So all the three lands, can we combine? Answer yes, we can calculate combined together. So FMV will take the total. How much is the total FMV? I hope you are clear about XN company. In case of XN company, only one land is transferred, land at Nagpur, to the partner. But as far as YN company is concerned, all the three lands are transferred to three partners. So we can have combined FMV of three lands. Full value of that will become full value of sale consideration. All the three lands together, 62 plus 59, that makes it 121 plus 70, 191 lakh. 191 lakh, we can combine them. 191 lakh is the sale consideration, which is FMV of 3 lands minus index cost of acquisition. Now index cost of acquisition will have to be computed for all the 3 lands individually. Chandigarh, Mohali, Gurgaon. Chandigarh, Mohali, Gurgaon. How much is the cost of acquisition? Cost of acquisition is 18.4, 15.24, 18.4, 15.24 and 16.7. 16.7 into 317, 317, 317. All three transferred in March 2022, that is financial year 21-22. Divided by what? Divided by CII number. So first land was acquired in Chandigarh in 2011-12. 11-12, the CII number of 11-12 is 184. So divided by 184. Then second land was acquired in 2015-16, September 15. The 2015-16, it is 2015-16 again 254. 254, right? 2015, and the last land was acquired in February 11. February 11, mind you, it will be financial year 10-11 and not 11-12. Financial year 10-11, 167 divided by 167. So I'm writing 191 little this side. Okay, now this I'll be calculating. This I have finished writing by myself. The total comes out to be 82.42 lakhs. 82.42 lakh. You can pause the video, calculate it by yourself. The difference would be, so the capital gain under section 9B, of course, will be long-term capital gain will be 108.58 lakhs. 108.58 lakhs, that is 1 crore 8 lakh 58,000. This will be long-term capital gain. So what is the question? Question is, what would be the taxable amount under section 9B for each of these two firms? So answer, for firm X and company the amount was 13.3 lakh and for Y and company it is 108.58 lakhs. 13.3108, 13.3108. Yes, the first answer is A. You can check the answer. Coming to question number 2. So I'm not checking B, C, D options. First option is the correct one. This is done. Second question, this is a bit lengthy question, so I'm going not faster, but I expect you to have read the question by yourself. Question number 2, second MCQ, what would be the capital gain taxable under 45(4)? Now section 45(4) is to be applied only in the case of X and company. This cannot be applied for Y and company. Why? Because in case of Y and company there is a dissolution, and when there is a dissolution only 9B is applicable. 45(4) cannot be applied. 45 subsection 4 can be applied only and only if there is a reconstitution, which is happening only in case of X and company. So 45(4) can be applied only for X and company. 45(4) cannot be applied for Y and company. I hope you are clear about this. In case you have yet to understand the provisions of 45(4), 48 clause 3, section 9B, then please watch my amendments video, which is also uploaded. Okay. What would be the capital gain? Of course, it will be not necessarily long term. We will see. Okay. In order to apply 45(4), if you recollect, we need to find out the capital account balance of Prem, the retiring partner, as on the date of reconstitution. So it will be this way: capital asset plus money. Capital asset, the FMV of whenever there is a capital asset plus money paid to the partner, retiring or deceased partner, 45(4) will be applicable in case of reconstitution. Value of money plus FMV of capital asset minus capital account balance of the partner. We will have to find out the new capital account balance. FMV of value of money and FMV of capital asset is already given here. Nagpur land 45 lakhs and money 15 lakh, total 60 lakhs. So this we know pretty well, that sale consideration will be 60 lakhs. But 60 lakh minus, we need to find out the capital account balance of partner Prem. So in order to find out capital account balance, we have certain steps to be followed given in Rule 8AB. Rule 8AB, step number 1, you first calculate the capital gain under section 9B. 9B capital gain we have already computed 13.3 in case of X and company, 13.3. However, this is the capital gain as per Income Tax Act after considering indexation. Step number 2, find out tax. Calculate capital gain under 9B. Step number 2, calculate income tax on the same. 13.3 is long term. Here we calculated 13.3. Now on this 13.3, let's calculate tax. So 13 point LTCG is 13.3 into 20%. Tax rate is 20%. Of course, we don't have the details of other incomes, so surcharge we will not apply, but surcharge, because 13.3 far below 1 crore. 13.3 into 20% will be 2.6 plus 6, 2 point whatever, I'll calculate it out, plus health and education says 2.66 lakhs, plus health and education says surcharge will not be there at the rate of 4%. Effectively it will be, we will calculate it out. That will be your step number 2. Step number 3, again calculate capital gain, but now this time you calculate capital gain as per books of accounts. As per books of accounts, this will be called as book profit. And as per book profit, as per books of account, how much will be the capital gain on this Nagpur land? The capital gain will be FMV 45 lakh minus book value minus 25.4. 45 minus 25.4. 45 minus 25.4. It will be 19.6. 19.6 will be called as book profit. Book profit. From this book profit, so step number 1, calculate capital gains. Step number 2, calculate tax. Step number 3, calculate book profit 19.6. Step number 4, from this book profit subtract income tax. How much will be the income tax? We'll have to compute right now only. So 13.3 into 0.2 into 1.04, 2.7664. Tax will be 2.7664. I hope you recollect the provision. This 2.7664 we will have to subtract from book profit. What we get now will be net book profit. Net book profit. This net book profit will have to be apportioned amongst 4 partners. Less 2.7664, how much would that be? Minus 19.6. 16.8336. 16.8336, that is 16,83,360, which is the net book profit. Next step. So this is your step number 5. Step number 6, this will have to be apportioned amongst the partners. This right now we are solving for X and company. X and company has got 4 partners, already discussed. 4 partners sharing profits and losses equally. So this will have to apportion amongst 4 partners. No need to apportion amongst all the partners. We can apportion it only for Prem. They share profits and losses equally. So Prem's share will be 1/4 of 16,83,360. Okay, so how much would that be? So let's calculate it out. 16.8336 divided by 4. 4.2084. 4,20,840 will be the share of Prem plus opening balance of capital. This is the profit as per books of accounts arising to firm 16,83,360 as per books of account. As per Income Tax Act it is 13.3, but as per books of account net of tax it is 16,83,360. So out of 16,83,860, share of Prem is 4,20,840. Prem's capital account balance will increase by this plus opening balance 32 lakhs. Prem's new balance, this is opening balance of capital account, total will be 36,20,840. This will be the new capital account balance. This will be called as capital account balance as on the date of reconstitution, as on 1st April 2021, as on the date of reconstitution. Prem is retiring. Now what to do? Now with the help of this new capital account balance, we will compute or we will apply section 45.4. 45.4 for X and company. For X and company. What to do? Full value of sale consideration will be equal to FMV of land at Nagpur. FMV of land plus money plus value of money given to him. I hope you recollect the formula for 45.4. 45.4 formula is A is equal to B plus C minus D. A, that is capital gain, equal to B plus C minus D. D is the capital account balance. What is B? B is money. How much money is given by firm to Prem? 15 lakhs. What is C? B plus C. This is the value of capital asset, which is 45 lakhs. So total becomes 60 lakhs. 60 lakh minus capital account balance of partner. Balance in capital account. However, balance in capital account is not to be taken at its original value 32 lakh, but a new capital account balance will have to be computed as per Rule 8AB that we already discussed here. Rule 8AB, step number 1, calculate capital gain under 9B, which is 13.3. Step number 2, calculate income tax on the same, which turned out to be 2.7664. Again, calculate capital gain on sale of that land at Nagpur as per books of accounts. That will be book profit. From that book profit, step number 3, reduce step number 2, income tax. What you now get will be net book profit. This net book profit apportion amongst partners in their profit sharing ratio. And now what we get will be the new capital account balance, and with the help of new capital account balance, we will apply 45.4. So 45.4 coming back here. Value of land is 45 lakh, money given to partner Prem is 15 lakh, full value of sale consideration therefore is 60 minus capital account balance, that will be new capital account balance which we just calculated, 36,20,840, 36,20,840. It will be 24,23,80, 23,79,160, 23,79,160. This will be capital gain under section 45.4. However, this 23,79,160, let's just check whether this is one of the option or not. However, before we proceed further in checking out the options, let me tell you that according to Rule 8AB, this 23,79,160, what will be the characteristics, long term or short term? Now this 23,79,160 is long term or short term, that will depend upon the assets which are left out after reconstitution. This will depend, the status of this 23,79,160 will depend upon whatever is the status of the remaining assets as on the date of reconstitution. How many assets are left out? 4 assets are given to you for X and company, including self-generated goodwill which is newly created, 70 lakh. However, Nagpur land is gone, so that I am removing. What is the increase? What is the amount of increase? First you find out what is the amount of increase in the value of remaining assets. What is the amount of increase in the value of remaining assets? As I said, this is going to be a time consuming question. This is the biggest question out of total 25 question. Remaining asset, by what amount the value has increased? So let's start with land at Pune. Land at Pune was worth 15 lakh at cost of acquisition. It has increased to 50 lakh rupees. That means there is an increase of 35 lakh. Now how much is the increase in the value of land at Nagpur? That we will not take into account because this asset is already transferred to partner Prem. So this is not a left out asset. Left out assets are only 3. 2 lands, Pune, Mumbai, these 2 lands and self-generated goodwill. For Mumbai based land, value was 88 lakhs, cost of acquisition has shot up to 250 lakh. That means increase of 150 plus 12, 162 lakhs. And self-generated goodwill whose original value was nil because it was not there only, and nil has become 70, so the value has increased by 70 lakhs. Okay, 35 plus 62 plus 70, that will be 197 plus 70, 267 lakh. 267 is the increase in the value of remaining assets, So whatever is the capital gain computed for X and company under section 45.4, this will have to be apportioned amongst the remaining 3 assets. This capital gain, whatever we are calculating under 45.4, is not the capital gain arising on the land which is actually transferred by firm to partner. This is the capital gain attributable to remaining assets. This we have already discussed in the lecture. In case you don't recollect, please watch the lecture on section 9b, 45.4, etc. So this will be attributable to land at Pune, Mumbai and goodwill. Pune land, Mumbai land and goodwill. Now goodwill is recently generated. It is recognized on the date of reconstitution. That means on the 1st April 2021. So goodwill is bound to be short term. Whatever is the capital gain 2379,160 under 45.4, whatever is out of 2379, whatever is applicable or whatever is attributable to land at Pune, that will be long term. Whatever is attributable to land at Mumbai, that will also be long term. Whatever is attributable to goodwill, that will be short term. Okay, so how much will be attributable to land at Pune? So this will be apportioned in the ratio of their increase in their value. 35 is to 162 is to 70, totaling to 267. 35, 162, 70. So I'll write it this way. So it will be 35, 162 and 70. So 35, 162 and 70 divided by 267. Total was 267. Divided by 267, 267, 267. I'll write down the answer for the sake of simplicity. So for land at Pune, the amount will be 311,875. In which ratio? In the ratio of increase in their value. For land at Mumbai, it will be 14,43,535, and for goodwill, which is short term, the amount will be 623,750. So how much is the capital gain under 45.4? The characteristic total is 2379,160, but the how much is long term, how much is short term, that will depend upon the status of remaining assets. So these two are long term, and this much will be short term. How much will be long term? The long term total would be 1755, 17 lakh 55. If you take the total of 311,875 and 1443,535, total is 1755, 410. And the short term is 623,750 in front of your eyes. Let's just check the answer. So MCQ number 2, question number 2, what would be capital gain taxable under 45.4? First is long term capital gain of 2379,160. Amount is correct, but it is not entirely long term, so first option is incorrect. Second option is long term capital gain of 2376,500. This is the wrong amount. Third is long term capital gain of 1755,410 and short term capital gain of 623,750. This is the correct answer. Last option is long term so and so, short term so and so. Wrong answer. Correct answer is C. I hope you are clear with this. Okay, in case you want to have a look at it again, you kindly have a look at it. Okay, in case you want to pause the video, you can always pause the video screen and take a screenshot. Proceeding further, third question, what would be the capital gain taxable under 45.4 for YN company? Now for YN company there is a dissolution and 45.4 does not come up in the picture in case of dissolution. 45.4 is applicable only when there is a reconstitution. We already discussed about it. If there is a reconstitution, both the sections will be attracted, but if there is a dissolution, then only 9B will be attracted. In case of YN company, there is only dissolution. Therefore, answer would be first, nil. You can keep checking the answers in between. What would be the question for? What would be the amount apportioned to land at Pune and land at Mumbai of X and company, which is to be reduced from full value of sale consideration in future? That means this is the question on how much will be the amount under section 48 clause 3. How much will have to be reduced? The answer, out of 2379,160, whatever is attributable to land at Pune and whatever is attributable to land at Mumbai, that much amount will have to be apportioned, or that much amount will have to be reduced while computing capital gain when these two lands are sold in future. This will be as per section 48 clause 3 read with rule 8AB. Rule 8AB. It's a classic question, though it's a lengthy question. I really enjoyed solving it. You will also enjoy only when you have read the question and tried solving it by yourself. If you are straight away watching this video straight away without even reading the provision, you will not understand anything in this video. Okay, so land at Pune, land at Mumbai, what is the amount? 311,875, 1443, 535. 311,875, 1443, 535. B is the correct answer. Other options don't seem to be correct. So fourth one is done. Now fifth one, the last one, last MCQ of case scenario 1, and then case scenario 1 will be over. Self-generated goodwill is sold in future in previous year 22-23, that is immediately next year. Still it will continue to remain short term, because for goodwill, in order to be classified as long term, period of holding should be more than 3 years, more than 36 months, and here it was just being created or self-generated on 1st April 21, so it is short term. Short term. For 80 lakh it is sold next year. What would be the capital gain on such sale? Now it is a self-generated goodwill, so cost of acquisition will be nil. So ideally full value of sale consideration is 80 and minus cost of acquisition. It is short term. Even if it was long term, indexation wouldn't have been possible because cost of acquisition was nil. So technically 80 lakh should be the capital gain. However, this will not be capital gain. What will happen is, what is the question? What would be the amount of capital gain? So what will happen is, from full value of sale consideration 80 lakh rupees, we will have to subtract under section 48 clause 3, we'll have to subtract whatever was the capital gain attributable to goodwill. Amount attributable to goodwill was 623,750. 623,750 will have to be reduced. Cost of acquisition will be nil. Cost of acquisition will be nil. Differential balance amount, which would be I think 74, 73, then 27, 67, 66, 250. 73, 66, 250. 73, 76, sorry, 73, 76, not 66. This B is the correct answer. With that, case scenario 1 comes to an end. Now the next is case scenario 2. Case scenario 2 is based on TDS and TCS provisions. TDS under section 194Q, newly introduced from AY 22-23. TCS and TCS under section 206C subsection 1H. But TCS was already introduced last year, financial year 2021, AY 21-22. TDS has been newly introduced under 194Q. 194Q was introduced with effect from 1st July 2021, that is applicable from financial year 21-22. TCS was introduced from 1st October 2020. Rate of TDS, TCS is same. This is TDS, this is TCS. Rate is same, 0.1%, 0.1%. Everything is same. Threshold limit is also same. However, the only difference is that even the turnover limit for the buyer and seller is also same. TDS is applicable only if turnover, sales, gross receipt of buyer, that is the payer, exceeded 10 crore rupees. Exceeded 10 crore rupees last year. Exceeded 10 crore last year. And TCS also same concept is applicable, but here turnover of seller instead of buyer exceeded 10 crore rupees last year. 10 crore last year. Provided the amount of purchase exceeds 50 lakh rupees in a year from the same seller, and here provided the amount of sale exceeds rupees 50 lakhs from the same buyer to the same buyer. Everything is same, rate is also same. The only difference is that which you need to understand is, what if both of them get attracted? 194Q is attracted in case where buyer's turnover exceeded 10 crore last year, and 206C1H TCS is applicable if seller's turnover exceeded 10 crore last year. What will happen if buyer seller, the turnover of both of them of the immediately preceding previous year exceeded 10 crore? Then what to do? Then in such situation TDS will prevail. First priority to be given to TDS, second priority to be given to TCS. One more thing, the sale limit or the limit of purchase is same in both of them. In TDS, purchase amount from the same seller should exceed 50 lakh, and in TCS, the sales value in a year from the same buyer should be more than 50 lakh rupees. Another thing, here it is actually a qualifying amount. TDS or TCS, at 0.1% is attracted only on the amount of purchase exceeding first 50 lakhs, and here on the amount of sales exceeding first 50 lakh. No TDS or no TCS on the first 50 lakhs in a year. This is the limit per buyer per seller. However, only thing which you need to remember is that if both of them get attracted, which is possible only if turnover of buyer and seller, both of them exceeded 10 crore rupees last year. If both the sections get attracted, then priority will be given to 194Q. However, one more thing to be noted is that in TDS, 194Q, TDS is attracted at the time of payment, at the time of actual payment, or at the time of crediting the account of the seller, crediting seller, whichever is earlier. So is not the case in case of TCS. TCS is attracted only at the time of receipt. Only at the time of, normally in TCS for some of these sections, taxes to be collected either at the time of receipt or at the time of debiting the account of the buyer, whichever is earlier. But for some provision, TCS is applicable only at the time of receipt. So is the case here, meaning thereby TDS at the time of payment or crediting buyer, whichever is earlier, but TCS will be attracted only at the time of receipt. This is one of the major difference. Another difference is that in case if the buyer or the seller, the other party, does not furnish his permanent account number or Aadhaar number, then in 194Q the TDS will be at the rate of 5% instead of 0.1%. Normally as per section 206AA, if the other party does not furnish, that is payee does not furnish his permanent account number or Aadhaar number, then the TDS is supposed to be at the rate applicable or at the rate of 20%, whichever is higher. Instead of 20%, here the rate will be 5%. Similar provision is there in TCS chapter. If the buyer does not furnish his permanent account number or Aadhaar number to the seller, then TCS will be at the rate of 1% instead of 0.1%. Remember, the rate is same, 0.1%, 0.1%, but if the other party does not furnish his permanent account number or Aadhaar number, then the rate here will become 5%, but here it will become 1% and not 5%. Then the rates are different. Please remember this. Okay. Even in my amendment sheet also, I have covered the difference between these two sections. I have highlighted this. This will be of a great help to you. 6 points. Remember, the date of applicability also matters, meaning thereby TCS was introduced first last year 2020-21 financial year, and this was introduced in the current year financial year 21-22. In case if the transaction takes place, so if both of them are attracted, then TCS will not be applied, TDS will be given priority, that we know. However, if both of them are getting attracted, that means turnover of seller and buyer both exceeded 10 crore last year, but if the transaction takes place after 1st October 20 but before 1st July 21, then by default you will have to apply TCS and not TDS. Remember this point. So coming back to the case scenario 2, Sunil, Shriram and Shyam are 3 brothers. Sunil, Shriram, Shyam, who are resident Indians, independent retail trade, engaged in independent retail trade business of food grains in Pune, Thane and Nagpur respectively. That's okay, that turnover. In case you want to finish reading the question slowly, I go a little faster, then you may pause the video and do the needful. As I told you before discussing case scenario 1. Their turnover for financial year 2021, that means last year's turnover was 9 crore, 10 crore and 12 crore respectively. So 9 crore and 10 crore are not exceeding. For Sunil and Shriram, it is not exceeding 10 crore, it is below 10 crore or up to 10 crore. Sunil and Shriram will not be subjected to 194Q. They are not fulfilling the primary condition of 194Q. But Shyam, his turnover is 12 crore last year, that means it is more than 10 crore, he will be required to deduct TDS. They regularly purchase food grains from another resident, Mr. Ashwath, a wholesaler in Mumbai. The turnover of Ashwath for financial year 2021 last year was 18 crore. Ashwath's turnover is 18 crore. Ashwath's turnover is more than 10 crore last year. But Sunil, Shriram and Shyam, for these 3 people, the turnover of only Shyam is 12 crore. Other 2 brothers is less than 10 crore or up to 10 crore. So what will happen? I'm sure you must have understood. So I would just highlight it up this way. Buyer is Sunil, Shriram and Shyam. Last year's turnover of Sunil was 9 crore, Shriram was .10 crore and Shyam it is 12 crore. Shyam's turnover last year is more than 10 crore. And who's the seller? Seller is Ashwath. Ashwath's turnover last year is 18 crore. All the three parties, Sunil, Shriram, Shyam, are buying from Ashwath in all the three cases. 18 crore, 18 crore, 18 crore is a turnover of Ashwath. Ashwath's turnover is definitely exceeding 10 crore. So in case of Shyam, turnover of both the parties last year is more than 10 crore. So here we'll have to decide what to do. TDS will apply or TCS will apply. But as far as first two transactions are concerned, between Sunil and Shyam, definitely TCS will apply. Ashwath will be required to collect the tax 0.1% of the sales value exceeding 50 lakh. Of course, we have yet to see how much is the sales value or the transaction value between Sunil and Ashwath and Shriram and Ashwath. If it is exceeding 50 lakhs, then only TCS will be attracted. But for these two transactions, TCS will be attracted, TDS will not be attracted. As far as transaction between Shyam and Ashwath is concerned, which one to be applied? So both of them are getting attracted, so priority will be given to TDS. Priority will be given to TDS. Let's just check what are the other provisions given or other information given in the question. I hope you are clear with this fundamental thing. When to apply TDS under 194Q and when to apply TCS under section 206C subsection 1H. They follow mercantile system of accounting. Okay, that means for TDS under 194Q, TDS is attracted at the time of actual payment or crediting the account of Ashwath, whichever is earlier. But in case of transaction between Sunil, Shriram and Ashwath, TDS is not going to be attracted, TCS is going to be attracted, and TCS is attracted at the time of receipt. We already discussed this. Further, aggregate amount credited by brothers to the account of Ashwath during each month of the current year 21-22. Amount credited by brothers to the account of Ashwath is shown in the table below. It may be assumed that the entire amount relating to Ashwath for a particular month is credited to his account on the last day of that month, credited on the last day of that month, but it is paid entirely on the last day of the immediately following month. January sales credited on 31st January, but payment is made on 28th February. Likewise, Ashwath also debits accounts of Sunil, Shriram, Shyam on the last day of the month with the amount of sales affected during each one. So debiting and crediting by both the parties are done on the last day of the month in which transaction takes place. The payment is made in the next month. Okay, value of purchases from Ashwath by Mr. Sunil, Shriram and Shyam. April 21 till January and then February and March. Okay, 12 months it's given. We don't need to check the individual details of each month. It is sufficient if we straight away jump to the total. Total is 86 lakhs in case of Sunil, Shriram it is 90 lakhs and Shyam it is 98 lakhs. In case of all three it is exceeding 50 lakh rupees. That means TDS, TCS provisions will be attracted. Then there is some extra paragraph given. Sunil's friend Krishna. Sunil is one of the three brothers. His friend Krishna entered into one-time transaction with Ashwath for purchase of food grains for 60 lakhs. Okay, again that means there are 4 buyers and 1 seller. Seller remains the same, Ashwath. One more buyer, Krishna, buying 60 lakh worth of goods on 30th June 2021, on which is a part of current year, on which date he credited the said sum to the account of Ashwath. Crediting is done on the same day, but the payment is made on 2nd July 2021. Krishna's turnover, that is buyer's turnover for the last year 2021 is 15 crore. Now again in this question, in this particular paragraph, we are going to face the same problem. Turnover of Ashwath is 18 crore last year. Turnover of buyer Krishna is 15 crore last year. So this also let me jot down. There is one more transaction which I am writing separately. Krishna is the buyer. Krishna's turnover last year is 15 crore and Ashwath is the seller. Ashwath's turnover is 18 crore last year. 18 crore. Turnover of both the parties last year was more than 10 crore. Now we are in a big dilemma whether TDS should be applied or TCS. However, just like Shyam's transaction, we discussed that TDS should be applied. Here also blindly we can say that wherever TDS, TCS both are attracted, then by default TDS should be applied. Agreed. However, the only difference between Shyam and Krishna, the problem is that in case of Krishna, the transaction is taking place in June 2021. This transaction is taking place in June 2021 of 60 lakh rupees. Payment is made in July. Payment is made on 2nd July 2021. Payment date is still fine, but the date on which it is credited, credit entries are passed. Ashwath's account is credited on last day of June month, that is 30th June 2021, and on this date TDS provision under 194Q was not there. 194Q was introduced with effect from 1st July 2021. TCS provision was already introduced last year. TDS provisions were not there as on the date of payment or crediting the buyer, crediting the seller, whichever is earlier. Which is the earlier date? In case of transaction between Krishna and Ashwath, payment is made on 2nd July 2021, that is after introduction of 194Q. Crediting is done on 30th June 2021, that is before introduction of 194Q. So which date is to be taken into account? Whichever is earlier, and earlier date is 30th June 21. As on 30th June 2021, TDS section 194Q was not there. Therefore, in case of transaction between Krishna and Ashwath, the date on which TDS should be deducted or the tax should be collected should ideally be 30th June. And as on 30th June 2021, TDS was not there. So though TDS should have been applied, priority should be given to 194Q. Then also in this transaction, there will be TCS and no TDS. Unlike transaction between Shyam and Ashwath. Are you getting this point? In case you want to, take a screenshot of this particular point, you are free to do that. You may kindly pause the video and do the needful. Okay, so now let's come to the question. Question number 6, on the basis of facts given above, select most appropriate answer. Are the provisions of TDS, that means 194Q, attracted in respect of purchase transactions with Ashwath? Answer yes, but only in case of third, that is Shyam's case. This one, Shyam. Here TDS will be attracted. Remaining transactions, there will be TCS, all the transactions. If so, in whose hands and at what rate? In whose hands? The answer in case of Shyam making payment to Ashwath. At what rate? The answer 0.1%. And at what point of time? The answer either at the time of payment or at the time of crediting account of Ashwath, whichever is earlier. So this will be applicable in case of Shyam to Ashwath, Shyam making payment to Ashwath, and making payment or crediting. What is the amount? 98 lakhs. So it will be 98 lakhs minus first 50 lakh. First 50 lakh no TCS, you know pretty well. So this will be attracted on 48 lakhs. Question is whether TDS will be attracted or not. So we just checked out of the 4 transactions, TDS will be attracted only in case of transaction between Shyam and Ashwath. Okay, ignore one-time transaction of Mr. Sunil's friend Krishna for the purpose of this MCQ. Okay, even if we don't ignore it, TDS is not going to be attracted. TCS would have been attracted in case of transaction between Krishna and Ashwath. 4 options, Shriram and Shyam are liable to deduct tax at 1%. Second, Shriram and Shyam are liable to deduct tax at 0.11. Okay, so first answer is definitely wrong because the rate given is wrong. Okay, C point, Mr. Shyam is liable to deduct at 0.1. This seems to be correct, Shyam. On the amount of each purchase after crossing threshold limit of 50 lakhs at the time of crediting the amount to the Ashwath's account. Answer yes, from 31st October onwards. This seems to be the correct because after 31st October it must have exceeded 50 lakhs. Last is Shyam liable to deduct at 1%. 1% is definitely wrong answer. So A and D become wrong answer because the rate is wrong. It could be B or C. In B, Shriram and Shyam both are given, and in C only Shyam. The correct answer is Shyam. You can check the answer. 7th MCQ, are the provisions of TCS attracted in respect of sale transactions affected by Ashwath? If so, from whom does he have to collect tax and at what rate and at what point of time? The answer, in case of transaction with Sunil, Shriram and Krishna. Ignore one-time transaction with Krishna. Okay, that means only two party. Which two people? First two. We already discussed this. Transaction with Sunil and Shriram, here TCS will be attracted. At what rate? 0.1%. On what amount? 86 lakhs minus 50 and 90 minus 50. So first two people, which two people? We already discussed here, Sunil and Shriram. If Krishna's transaction is ignored, Sunil and Shriram, Ashwath has to collect tax, that is correct, from Sunil and Shriram at the rate of 1%, making it a wrong answer. Second option, Ashwath has to collect from Sunil and Shriram at the rate of 0.1%, this seems to be correct, on the amount exceeding 50 lakhs at the time of receipt. Absolutely, at the time of receipt, this is the correct answer. TCS is attracted at the time of receipt only, unlike TDS. C point, Ashwath has to collect tax 1%, 1% is the wrong answer. Ashwath has to collect 0.1% from only Sunil. No, correct answer will be B. Clear about this? The next one is MCQ number 8. What would be the applicable rate of TDS if Mr. Ashwath fails to furnish permanent account number? Rate of TDS. So if this rate of TDS is concerned, no. So as I already told you, rate of TDS and TCS both are same, 0.1%, 0.1%. But if PAN number not furnished, permanent account number, here 5%, here 1%. What would be the applicable rate of TDS if Mr. Ashwath fails to furnish permanent account number? Who has to deduct TDS out of the 4 transactions? TDS is applicable only in case of transaction between Shyam and Ashwath. What would be the rate? Based on answer to MCQ 6. Also, what would be the applicable rate of TCS if the collectee based on answer to MCQ 7 fails to furnish permanent account number to Ashwath? Okay, rate of TDS will be 5% if permanent account number is not provided by the other party. Rate of TCS will be 1%. TDS rate will be 5%, TCS rate with the same default will be 1%. 5%, 1% respectively. B is the correct answer. MCQ 8 is done. This you please keep it in mind. Many people were confused when I was teaching this. That is the reason I have covered this table. Difference between or brief comparison between 194Q and 206C1H. Okay, fine. Proceeding for the 9th MCQ and then 10th. If value of purchases by Mr. Shyam from Mr. Ashwath was 70% of the monthly figures given in the table. If the transaction between Shyam and Ashwath, what is happening is TDS is getting attracted, this transaction. TDS is getting attracted, which should be the sale transaction or the purchase amount should be more than 50 lakh. What will happen if the value of purchases by Shyam from Ashwath is 70% of monthly figures given in the table? Then what would be the rate of TDS or TCS implication? Answer, let's just check out. Shyam. So in case of Shyam, the transaction value is 98 lakhs. If 98 is taken at 70% level, 98 into 70%, then just check whether it is still exceeding 50 lakhs or not. 70 lakh minus 1.4, that will be 68.6, 68.6 or whatever may be, 68.6. Yes, you can calculate it out. 70 lakh minus 1 lakh 40. Yes, 68.6. 68.6 is still more than 50 lakh. TDS, TCS will still be attracted. But TDS is going to be attracted, we know pretty well. 68.6 minus first 50 lakhs. First 50 lakh, no TDS, TCS, 18.6. Whatever will happen to 18.6. Shyam has to deduct tax at source on purchase of 18.6 with effect from 31st December. Maybe after 31st December it is exceeding 50 lakh. Second, Shyam need not deduct tax since payment for purchase transaction with Ashwath after the date. Ashwath is after the date when TDS provision came into force, does not exceed 50 lakh. No, this is absolutely wrong interpretation. In order to apply the limit of 50 lakhs, we have to see the purchase transaction from the beginning of the year. Even though section was introduced from 1st July 21, but in order to find out whether 50 lakh limit is breached or not, we need to take into account the transaction of purchase from the 1st April 2021. So second is a wrong answer. C, Ashwath has to collect tax. Collecting tax is definitely wrong answer. Both B and C are correct. No. Correct answer is therefore A, Shyam has to deduct TDS under 194Q on 18.6. How did you get 18.6? 68.6 minus first 50 lakh. 10th and the last MCQ with regards to case scenario 2. What would be the TDS TCS implication in respect of single purchase transaction by Krishna from Ashwath? For that single transaction we already discussed. What will happen is, this is what will happen. TDS will apply or TCS will apply, TCS will apply and not TDS. Unlike transaction between Shyam and Ashwath where TDS was going to be attracted, ideally turnover of both the buyer and seller is more than 10 crore last year. So ideally TDS should prevail over TCS. Agreed. But here TCS will be attracted because transaction is taking place in June 21. Payment or credit, whichever is earlier, is happening in June 21, and in June 21 when the liability arises, as on that day 194Q was not there. 194Q was introduced on 1st July 2021. Therefore TDS is not possible. So what will happen is TCS will have to be, tax will have to be collected by Ashwath. Krishna has to deduct wrong answers. Krishna has to deduct wrong answer. Krishna has to deduct wrong answer. Ashwath has to collect. This is the correct answer by default. On 2nd July 21 on 10 lakh. Now TCS is always at the time of receipt. Therefore 2nd July 21 will be considered. On 10 lakh being the amount exceeding 50 lakh. Correct. 60 minus first 50, 10 lakh. With that, case scenario 2 comes to an end. Now the next 5 are loose MCQ 11, 12, 13, 14, 15. Let's just understand them. Now proceeding further with 11th one. Now 11 till 15, the next 5 MCQs are in the form of loose MCQs. All of them are based on the latest provisions. All of them are based on amendments which are carried out by Finance Act 21. This is on assessment of public charitable trust and religious trust. This is on corpus donation. Poor Aid is a charitable trust. I would suggest that before you watch this video, please glance through the question by yourself so that we can go a little faster. Poor Aid is a charitable trust registered under section 12 AB. Its main object is relief for poor. During the previous year 21-22, it received 50 lakh rupees by way of corpus donations, out of which it invested 85% of 50 lakhs, that is 42.5 lakhs in post office savings bank account. Now this is based on the latest provision. We know pretty well that till AY 2021, corpus donations were not regarded as income. Corpus donations are capital receipt. However, amendment has been carried out in 11 subsection 1 clause D, section 11 subsection 1 clause D, stating that corpus will no more be called as income. Corpus will not be considered as income subject to a condition that it is entirely invested or deposited in one or more specified modes of investments specified under section 11 subsection 5. There are 14 modes of investments specified under 11.5. So it says 50 lakh is the corpus donation. Corpus were not to be regarded as income unconditionally, but now corpus will not be income provided it is invested in specified modes. Only 42.5 lakh has been invested. Post office savings account is one of the specified modes. So 42.5 will not be considered as an income, but 7.5 lakh will be regarded as an income. It was of the view, trust is of the view that 7.5 lakh being 15% of 50 lakhs is eligible for unconditional accumulation. Totally wrong. This 7.5 lakh will be chargeable to tax. But how? That has not been clarified by government, unfortunately. Whether 7.5 entirely will be taxable straight away or 7.5 lakh will be considered as a normal income, that government has not clarified. We already discussed this in amendment lecture. Trust also withdrew 2.5 lakh out of that 42.5 lakh. So step number 1, they received 50 lakhs. Step number 2, out of 50, 42.5 is deposited in post office savings account. Step number 3, out of that 42.5 deposited in savings account, they withdrew 2.5 lakhs out of 42.5 and applied the same for the relief of the poor, which is their main object. Now the question is whether application out of withdrawal from investments made out of corpus donation, will that be regarded as application of income? Answer no, as per amendment, this will not be regarded as application of income in the year of spending it, in the year of applying it. This, however, will be regarded as application of income only in the year in which the amount 2.5 lakh or whatever amount is spent, it will be considered as application of income not in the year of spending the money for approved object, but it will be regarded as application of income in the year in which it is reinvested back or redeposited back in the specified modes of investment. Examine the tax implication. Number 1, trust is eligible for unconditional accumulation of 7.5 lakh. Totally wrong, being 15%. This is certainly wrong answer. Trust would be eligible to treat 2.5 lakhs withdrawn from post office savings bank account as application of no. This is again wrong point. Third, trust will not be eligible for benefit of exemption of 7.5 lakhs unless it invests such amount in any of the modes specified in 11 subsection 5. Yes, this is correct. 42.5 is already invested. 7.5 also needs to be invested, otherwise it will not be entitled to any kind of benefit of exemption on 7.5. Correct. Fourth point, amount of 2.5 lakh withdrawn from post office savings account cannot be treated as application. Answer, this is also correct, but this is correct for the current year, which is the current year given, previous year 21-22. This will not be 2.5 lakh, though it is applied towards approved object, will not be considered as an application of income for previous year 21-22. Whenever it is redeposited back from the income of future year, then it will be regarded as application of income in that year in which it is redeposited. 3 and 4 are the correct point. 1, 2, 2, 3, 3, 4. C is the correct answer. Next one is 12th one. This is on section 43CA of PGBP chapter. 43CA, which is similar to 50C of capital gain chapter. Whenever immovable property is sold, if immovable property is sold as capital asset, then section 50C will be applicable, and if it is sold as stock in trade, then 43CA of PGBP chapter is applicable. This is a very interesting question. There has been an amendment in 43CA. Second proviso to section 43CA has been introduced in the current year, but applicable from last year. As I said, 70-75% amendments carried out by Nirmala ji are applicable retrospectively from last year instead of being applicable from current year. This has become a new fashionable trend of finance ministers. Okay, proviso 2 to 43CA we will discuss. ABC developers have completed residential housing project Ashiana Gardens in Faridabad in May 21. Okay, current year. It comprises of 8 residential units. 3 of them were transferred to home buyers in June 21 and remaining 5 units were transferred to home buyers in July 21. Out of 8, 3 are transferred in June 21 and 5 are transferred in July 21. All the units were transferred by way of first time allotment to the home buyers. Okay, now what is it? So section 50C of capital gain chapter as well as section 43CA of this chapter, PGBP chapter, both of them say that in case of immovable property sold, that is land plus building, the sale consideration will be higher of following two. Sale consideration will be equal to higher of following two, will be either actual sale consideration or stamp duty value. However, stamp duty value is to be taken into account only if the stamp duty value exceeds 110% of actual sale consideration. Government has introduced some tolerable band. Few years back only this was introduced. Earlier it was 105%, now it is 110%. Meaning thereby, government says if the difference between actual sale consideration and stamp duty value is up to 10% of actual, then government will not consider 43CA or 50C. Now in 43CA section, amendment has been carried out stating that instead of 110 it shall be 120. Stamp duty value will be taken into account for making comparison between which one is higher. Stamp duty value will be taken into account only if it exceeds 120% of actual. If 4 conditions, instead of 110, the tolerable band will be 120. If 4 conditions are satisfied, one of the condition is 43 CA, let us understand. One of the conditions is it should be sale of residential unit. Another condition is should be transferred between 12th November 2020 till 30th June 2021. Another condition is sale consideration should not exceed 2 crore rupees, 2 crore rupees each residential unit, and it is sold by way of first time allotment. First time allotment. What is first time allotment? First time allotment means it is not a second hand property. It is directly sold by builder to the buyer, to the end user. Primary market sale and not secondary market. Number one, it should be residential unit. Residential unit. Number two, it should be sold between 12th November 20 and 30th June 21. Acha. Now, if these conditions are not satisfied, if any of these four conditions are not satisfied, then 43, it does not mean 43 CA will not apply. If conditions are satisfied, then we will take 120%. If conditions are not satisfied, then we will take 110%. 43 CA continues to be applicable. So now what is given here is out of the 8 units, 3 of them are sold in June 2021 up to 30th June 21. Condition is satisfied for 3 units. Remaining 5 units are sold in the month of July 21, which is after this particular time limit, July 2021. So what will happen is the benefit of for these 3 units we will take into account 120%, and for these 5 units we'll have to take 110% of the actual consideration. So what is it? What are the further details given? All the units were transferred by way of first allotment. Consideration receipt for each unit is 25 lakh, which is below 2 crore or within 2 crore limit, and the same was received by prescribed electronic modes. Okay. Stamp duty value of each unit was however 30 lakh rupees. Actual consideration is 25, stamp duty is 30 lakhs. Okay. That means 30 lakh is definitely, it's just 120%, dot 120%. Stamp duty value is to be taken into account if 4 conditions are fulfilled, then stamp duty to be taken into account only if stamp duty value exceeds 120% of actual. So 30 lakh is dot 120% of 25 lakh. It is not exceeding 120%, it is dot 120%. Both in June and July, stamp duty value remained the same. What would be the full value of consideration for the purpose of computing PGBP income? What will be the sale consideration or total value, yeah, full value of consideration? So what we'll do is that here in question number 12, actual, if you can understand, is 25 lakh. Stamp duty value is 30 lakhs. 110% of 25 lakh would mean 27.5 lakh, and 120% of 25 lakh would mean 30 lakh. So stamp duty value is to be taken into account only if the stamp duty value exceeds 27.5 or exceeds 30 lakhs. So out of the 8 units, for 3 of the units, June 21 is the date of sale, so 120% will be applicable. And for 5 units which are sold in July 21, 110% will be applicable. Stamp duty value is 30 lakhs, which is definitely more than 110%, but it is not more than 120%. So for these 3 units, we will take into account 25 lakhs only, because stamp duty value is not exceeding 120%. And for these 5 units, we will take stamp duty value or the actual, whichever is higher. I hope you are understanding this. 125 lakh will be sale consideration for these 3 units, and for these 5 units it will be 150 lakhs. Totaling to 5 units into 30 lakhs, totaling, because 110% limit, totaling to 275 lakhs. No, not 275, just a sec. 3 into, sorry, this will be 75, 3 into 25, that's what I was checking. So total would be 225 lakh, that is 2 crore 25 lakhs. Is 2 crore 25 lakh? Yes, C is one of the answer. Getting this point, 43 CA based on amendment. Now the next is 13 point. This is very interesting. 13 is on transfer pricing. Transfer pricing, section 92C, 92 CE and 92 CB. 92 CB. Three sections are attracted here, transfer pricing based question. Why am I writing down the section number or the title of the chapter, transfer pricing, on left hand side, so that when you are revising you can easily locate the question. Please read the question before you watch this video or before you watch video further. EBITDA of ABC Limited. By reading the word EBITDA, that is earning before interest, depreciation, tax and amortization, you must have understood what the question would be on. EBITDA of an Indian company for the current year is 10 crore, okay, and 30% of EBITDA would be 3 crore. We know pretty well. It paid interest of 5.2 crore to PQR Incorporation UK, which is specified foreign company. Now institute should not have used this kind of language. This is confusing. What do you mean by specified foreign company? By specified foreign company, institute is trying to say that ABC Limited and PQR are associated enterprises of each other. But they should clearly specify that these two are associated. They should not say specified foreign company. There is nothing called specified foreign company in case of transfer pricing chapter. There is no such concept. Specified foreign company. What is it? In relation to ABC Limited. It is specified in relation to ABC. Okay, that means associated enterprise. Okay, transfer pricing will be attracted. Arm's length price using cup method was 4.15 crore. So 5.20 crore is actually paid, but as per cup method 4.15 crore is allowable. Difference is 1 crore 5 lakhs, 1.05 crore. 92C will be applied, and as per section 92C read with section 92, 1.05 crore will be disallowed to ABC Limited. And ABC Limited suo moto made the transfer pricing adjustment. Suo moto underline. If suo moto adjustments are made, then this excess money 1.05 crore will have to be repatriated back to India within 90 days from the due date of filing IT return. Do you remember this? Section 92 CE, secondary adjustment. While computing total income, if assessee is making primary adjustment suo moto, then secondary adjustment, that means repatriation of this excess money 1.05 crore will have to be carried out within 90 days from the due date of filing IT return. On the basis of the above facts, examine the correctness of the following statements, assuming that there is no other interest payable by ABC Limited. Fantastic. So here what is happening is two types of disallowances will be attracted. One will be disallowance under section 92, which will be permanent disallowance. Another will be disallowance under section 92 CB, which is interest paid payable in excess of 30% of EBITDA. This will be temporary disallowance, this will be permanent disallowance. Both of them may be attracted, and if you recollect, no other teacher explains this concept, but I had explained it to you in the class. I have seen the videos of other teachers also, they are also confused. Whenever there is section 92 and 92 CB both getting attracted on different amounts, then both of them will be attracted. First effect to be given to section 92 and then second effect to be given to 92 CB. We have to go in the chronological order of section numbers, right? Okay. Now A, B, C, D, 4 options are given to us. Let's just work it out. EBITDA is 10 crore. Actual interest is 5.2 crore. 10 crore EBITDA. Actual interest is 5.2 crore. As per arm's length price, interest allowable is 4.15 crore. Okay, based on these details, we'll have to work it out. Question number 13. So question number 13 I'm writing here. So first we will apply section 92 read with section 92C, cup method. Under this, how much will be disallowed? 5.2 crore is actually paid. As per ALP, 4.15 crore is allowable. Therefore, disallowable will be 1.05 crore. This much will be disallowed as a deduction, but this will be permanent disallowance. This is gone, permanent disallowance, and this amount which is disallowed under section 92C will be called as excess money. This will be excess money. This will have to be repatriated back to India within 90 days. Repatriation in 90 days. This is first part. Now the second part is section 94B. 94 only B, not CB. 94B, okay. 94B, which is temporary disallowance, lower of the following two will be disallowed. Lower of the following two. Number 1, interest paid payable. Interest paid or payable. Now though it is saying interest paid or payable, minus 30% of EBITDA, 30% of EBITDA, or interest paid payable. Now while discussing in the lecture, we had discussed about this issue, what is the exact language used in the act and what is the interpretation of institute. Interest paid payable to associated enterprise, interest paid payable to AE. Now whether interest paid payable, so first of all, in the act it is given first point interest paid payable, that means total interest, and in the second point it is saying interest paid payable to non-resident associated enterprise. However, our institute is of a different opinion. According to our institute, first point also it should be interest paid payable to associated enterprise. This is the institute's interpretation. Now the question is, what amount should I take here? 30% of EBITDA, it's okay, that means 30% of 10 crore. This will be 3 crore, I understand. How much is the interest paid payable? The interest paid payable is actually 5.2 crore. Whether 5.2 crore should be taken into account or 4.15 crore should be taken into account. The answer is 4.15 crore should be taken into account and not 5.2. When we say interest paid payable, it should be understood as interest paid payable for which deduction is going to be allowed. So interest paid payable is 5.2 crore, but deduction is going to be allowed only for 4.15 crore. Remember this, understand very carefully. So first you apply section 92 plus 92C, disallow this permanently, and after disallowing you take into account 4.15 crore now. So now interest paid payable to associated enterprises 4.15 crore. Even in second point also it will be 4.15 crore. 4.15 crore minus 3 crore, 30% of EBITDA, 1.15 crore. 1.15 or 4.15, whichever is lower, 1.15 crore will be disallowed. 1.15 crore will be disallowed under section 94B. And this will be temporary disallowance. So two disallowances, one will be 1.05 crore permanent disallowance, and number two, 94B temporary disallowance, which will be 1.15 crore. Let us understand. So what are the options given to us? First, option number A. I hope you are clear about this. Arm's length adjustment as per section 92C would be 1.05 crore, correct. Excess interest under section 94B would be 1.15 crore. This is also correct. This seems to be the correct answer. Secondary adjustment is required to be made in respect of 2.2 crore. No. Secondary adjustment is required only for that much amount which is permanently disallowed. What is to be repatriated back, that is secondary adjustment, is only 1.05 and not this 1.15. 1.15 is a temporary disallowance. This is not required to be repatriated back. Therefore, first option is wrong. Second, excess interest under section 94B would be 2.2 crore. No, wrong. No secondary adjustment, totally wrong. Third point, option C, excess interest under 94B would be 2.2 crore. Secondary adjustment under 92CE is required to be made in respect of said amount. No. The arm's length adjustment under section as per 92C would be 1.05, correct. Excess interest under 94B would be 1.15 crore. This is also correct. Secondary adjustment is required to be made in respect of only 1.05 crore, which is permanent disallowance. Absolutely, this seems to be the correct answer, unless ABC Limited opts to pay additional income tax. If you recollect, this is the correct answer. Now 14, I hope you are clear till here. Now the next is 14th. Now 14 is based on section 9 subsection 1 clause 1, 911, that is income deemed to be accruing or arising in India. This is the international question, international taxation related question. MNO Incorporation and PQR Incorporation are two country M based companies, that means foreign companies engaged in trading of oil seeds. MNO Incorporation sold oil seeds of the value 1.8 crore during the previous year 21-22 to XYZ Limited, an Indian company. MNO Incorporation, PQR Incorporation. This MNO sold oil seeds worth 1.8 crore through an agent in Delhi who secures orders in India mainly for MNO Incorporation. That means for MNO Incorporation, that Delhi based agent would be dependent agent. Explanation 2 to section 911. Explanation 2 states that if the foreign company or a non-resident has dealings in India or business in India through a dependent agent, that means agent working mainly for that non-resident or only for that non-resident, then that agent will be dependent agent. Then in such situation, the foreign company or the non-resident will be deemed to be having business connection in India, and accordingly income from transaction in India will be deemed to be accruing or arising in India. At the same time, PQR Incorporation also sold oilseeds of the value 2.10 crore during 21-22 to XYZ Limited. Both of them are selling to XYZ Limited only through an independent agent. But what is happening is MNO is selling through dependent agent and PQR is selling through independent agent. So independent agent does not constitute business connection in India. Okay, I repeat, to PQR Incorporation sold oil seeds of the value 2.10 crore during the previous year 21-22 to XYZ Limited through an independent agent carrying on agency business in Mumbai. The independent agent in Mumbai renders services to many other oilseed trading companies which are not related to PQR Incorporation in any manner. That means that agent is purely an independent agent. Both MNO Incorporation and PQR Incorporation do not have a PE in India. They don't have a PE. Okay, so business connection in India could be developed either through PE or through dependent agent. So MNO is selling goods in India, oil seeds in India worth 1.8 crore through dependent agent. So MNO Incorporation is certainly having business connection in India, but PQR Incorporation is not selling goods through dependent agent, they are selling through independent agent. And they are not having PE in India, that means they are not having branch in India. Examine the taxability of income earned by MNO and PQR from their sale transactions with XYZ Limited based on the provisions contained in section 9(1) of the Act. Ignore DTAA if any. Beautiful question. Okay, simply what is happening is, this is a question based on explanation 2 as well as explanation number 2A. Explanation 2A is about significant economic presence, SEP, which was introduced by Finance Act 2018, Finance Act 18, but applicability was later on postponed to AY 22-23. So in my amendment sheet, latest amendments, I have covered this explanation 2A also. I mentioned also it was introduced by Finance Act 2018, but it was postponed to AY 22-23 by Finance Act 20. Meaning thereby what is happening is, if you can understand, so MNO Incorporation and PQR Incorporation. MNO is selling goods worth 1.8 crore. PQR is selling goods worth 2.10 crore. MNO is selling goods, that is oil seeds in India, through dependent agent. Whereas PQR is selling goods in India through independent agent. So how does that matter? So MNO Incorporation is certainly having business connection in India. Its income from sale of oil seeds worth 1.8 crore will be definitely be deemed to be accruing in India. But as far as PQR is concerned, it is selling goods through independent agent. But now, so for MNO, explanation 2 will be applicable. Explanation 2, dependent agent permanent establishment, DAPE concept. Whereas for PQR, explanation number 2A will be applicable. According to explanation 2A, which I'll explain you, I'm sure you must have forgotten. In case you are not able to recollect, please glance through it. Explanation 2A states that in case if the foreign company or a non-resident has a significant economic presence in India, SEP, then it will be deemed to be having business connection in India. Accordingly, income will be deemed to be accruing in India. So PQR's income will also be deemed to be accruing in India. 911 section will be applicable to both of them, but because of different reasons. For MNO, explanation 2 of section 911 will be attracted. For PQR, explanation 2A will be attracted. In order to be called as significant economic presence, SEP, the transaction value in India from sale of goods, providing services including downloading of data should be exceeding 2 crore rupees, and it is 2.10 crore. It's 2.10, right? 2.10. Therefore, Therefore, PQR incorporation, though it is selling goods through independent agent, it will be deemed to be having significant economic presence in India. Therefore, it will be deemed to be having business connection in India. Okay, so what are the conditions to be called as significant economic presence? Either the amount of transaction should be more than 2 crore in a year, or the number of users, number of active users should be more than 3 lakhs. Number of registered users should be more than 3. Let me explain it to you. So, it is hereby declared that significant economic presence of a non-resident in India shall constitute business connection in India. And significant economic presence means any of the following two, A or B. However, the amount which I told you, 2 crore rupees or 3 lakh users, that is given in Rule 11 UD. Either they are having transaction worth more than 2 crore in a year, transaction with regards to goods, services, property carried out by non-resident in India, or the number of users exceed 3 lakhs as given in Rule 11 UD. The limit of 2 crore or the limit of 3 lakhs of users is given in Rule 11 UD. 2 crore limit is being breached, therefore it will be deemed to be having significant economic presence in India. So what are the options given to you? Number A, income of MNO incorporation attributable to operations carried out in India by its agent in Delhi. Income of MNO would be deemed to be accruing in the hands of MNO and be chargeable to tax. Very poor quality language is used by our institute. Question is beautiful, but the language which is used is slightly lengthy. Unnecessary wordings are being used. They could have kept it short and sweet. MNO incorporation, income will be deemed to be accruing in India. Income of PQR attributable to sale transactions with XYZ Limited would also be deemed to be accruing or arising in India. A seems to be the correct answer. Income of simply both of them. B point says no part of the income of MNO or PQR will be deemed to be accruing. This is definitely wrong answer. C point, income of MNO would be deemed to be accruing and chargeable to tax, but not the income of PQR. This is again wrong answer. Income of PQR will be deemed to be accruing, but income of MNO will not be. Again wrong answer. Correct answer is, so 4 options are given to you. Number A, income of both of them will be deemed to be accruing in India. That's the correct option. B says none of them. C says only of MNO, and D says only of PQR will be deemed to be accruing in India. Correct answer is A. I hope you are clear with this. Section 9 subsection 1 clause 1, explanation 2 which was already there, explanation 2A, significant economic presence. Now proceeding further, question number 15. Question 15 is on residential status. Residential status of individual. Residential status of individual is governed by section 6 clause 1. However, there have been major amendments carried out last year, AY 21-22, in section 6 clause 1. So by default, for residential status, section 6 clause 1, residential status of individual, it says that 2 basic conditions. Basic condition number 1, the person, that is individual, is present in India in the current year for 182 days or more in the current year, current previous year, plus second basic condition has got 2 sub condition. He is present in India for 60 days or more in the current year, it's 1 or 2. And in 2, A plus B. B says that he is present in India for 365 days or more in the immediately preceding 4 previous years, last 4 previous years. However, so first condition is 182 days or more. Second condition has 2 sub conditions, 60 days or more in the current year, or 365 days or more in the last 4 previous year. However, condition number B, BA, second condition's A part, will stand modified if some conditions are fulfilled. So there were some exceptions that in some cases 60 days is to be kept 60 days, some situations 60 days is to be replaced by 120 days, and in some situations 60 days to be replaced by 182 days. So this question is based on that. Let's read the question to understand it. Please glance through provisions of section 6 clause 1. There are 4 different categories, category 1, 2, 3, 4. For some category, time limit instead of 60 days would be replaced by 120 days if Indian income exceeds 15 lakh rupees. Okay, Raj is an Indian citizen living in country T. Raj, Indian citizen, for the last 10 years living in country T. His brother Rahul also left India 10 years before, that is 10 years back, and settled in country Q. He has become, that is Rahul has become citizen of country Q But prior to that, that means Raj is Indian citizen. Both are staying out of India. Raj is staying in country Q, but he is citizen of India. Rahul is staying in country T. Sorry, Raj is staying in country T. Rahul is staying in country Q. But Raj is citizen of India. Rahul has ceased to be citizen of India. Rahul has become citizen of country Q. Prior to that, they have always been in India since birth. That means born and brought up in India. So both of them are persons of Indian origin, but only Raj is citizen of India, Rahul is not a citizen of India. So when we are applying these rules of residential status, sometimes the conditions are based on citizenship, sometimes exceptions are based on origination, whether person of Indian origin or not. Okay, reading further, prior to that they have always been in India since birth. Their parents were also born in India. Okay, both of them come on a visit to India during the entire months of June, July and August every year up to previous year 2021, means up to last year, entire month of June, entire month of July, entire month of August. June has 30 days, July has 31 days, August has 31 days, totaling to 92 days. Every year they are visiting India for 92 days, but not in the current year. It is up to 2021, up to last year. Both brothers decided to start a business in India and hence visited India. For what purpose they are visiting in India, that is immaterial. They are visiting in India, that is important, for setting up the business on 1st December 21. For setting up business in India on 1st December 2021. Okay, fine. The income of Mr. Raj and Mr. Rahul is 20 lakhs each. Income is okay. So that means our decision would be based on amount of Indian income. If Indian income is greater than 15 lakhs, then the rules are slightly different. Out of which income from foreign sources is 5.5 lakhs for Raj and 4.5 lakhs for Rahul. Okay, so Raj and Rahul, what is happening is income of both of them is 20 lakhs, but foreign income, which I am removing to find out Indian income, foreign income of Raj is 5.5 lakhs. So Indian income would be 14.5, and for Rahul 4.5 lakh is the foreign income, so Indian income will be 15.5. So Rahul's Indian income is more than 15 lakhs, Raj's for Indian income is less than 15 lakhs. This is Indian income, total income minus foreign income. Okay, they left India for the respective countries on 3rd April 22. 1st December 21 they are coming to India, 3rd April 22 they are leaving India. However, our financial year ends on 31st March. Financial year ends on 31st March. Our calculation will be from 1st December 21 till 31st March and not till 3rd April. So how many days these two brothers are present in India? Have they come to India in the month of June, July, August? No. These 92 days which they come to India every year, this year they have not come to India for these 3 months. That means presence in India will be strictly be from 1st December 2021 till 31st March 2022. So how many days they are present in India? Both, Raj and Rahul both. December 31 days, January 31 days, February 28 days, it's a non-leap year, February 2022, and March 31 days. 1, 2, 3, 4, 121 days they are present in India. You can take the total, 121 days. Now 121 days, so definitely first basic condition none of them are fulfilling. First basic condition, though they are certainly not fulfilling, either of them. Second basic condition, but second basic condition will have to check. Second's B part is fulfilled by both of them. 92 days they come to India every year. So in last 4 years they must have come to India for 368 days. 368 days. So this condition 2B is fulfilled. 2A, but before we check whether 2A is satisfied or not, we'll have to find out whether the limit of 60 days is to be applied or 120 days or 182 days. So we will see what to do. So in case you recollect, in my notes I have categorized them. In my notes I have divided residential status of individual into 4 categories. Category 1, 2, 3, 4. This is general rule. In that category 2 category 2. Second category states that in case of person who is citizen of India or person of Indian origin if Indian income, citizen of India or Indian origin, and Indian income is greater than 15 lakhs. Second possibility, Indian income is up to 15 lakh. Now whether Raj and Rahul will be covered by category 2 or not, the answer is definitely they are. Out of these two, Raj is citizen of India, Rahul is not. But as far as PIO is concerned, they both of them are persons of Indian origin. They were also born in India, their parents were also born in India. The second condition is fulfilled by both of them. Second as in like PIO. Either the person, in order to fall under category 2, the person should be, individual person should be either citizen of India or person of Indian origin. So citizen of India, only one of them is there, person of Indian origin, both of them are there. Plus next condition, Indian income should be exceeding 15 lakh. If Indian income exceeds 15 lakh, then two basic conditions will be this way: 182 days or more in the current year, or second A, 120 days or more in the current year, plus 365 days or more in the last 4 previous years. But if the Indian income is up to 15 lakh, then in that case, first condition is 182 days or more in the current previous year for a citizen of India or person of Indian origin living outside India, coming to India for a visit. Second category means what? Either a citizen of India or person of Indian origin. Second condition, residing outside India. Third, coming to India for visit. And next condition, Indian income is more than 15 lakh. Then second A, instead of 60 days, it is to be replaced by 120 days, provided Indian income is greater than 15 lakh. But if the Indian income is up to 15 lakh, then second basic condition, part A, 182, 60 days will be replaced by 182 days. 182 days in the current year plus 365 days in the preceding 4 previous year. Last 4 previous year. Now the question is, who's fulfilling which condition? So Raj and Rahul, both of them are PIO, both of them are residing abroad, both of them come to India for a visit. For what purpose they are coming, that is immaterial. So both of them fall under second category. However, for Raj, the time limit to be considered, Raj's Indian income is 14.5. So he will be deemed to be resident in India only if his stay in India is 182 days or more. As far as Rahul is concerned, we'll have to apply his Indian income is 15.5. Therefore, second basic condition, time limit will be 120 days. Raj, Indian income 14.5. Raj will fall under this category. This is for Raj. This will be for Rahul. Indian income is greater than 15 lakh. This will be for Rahul. This will be for Raj. Now, based on this, decide whether they will be resident in India or not. What is the question? Residential status is to be determined. I hope you are understanding this. So, what is the number of days of stay in India? Number of days of stay in India we just calculated. They both are in India in the current year for exactly 121 days. 121 days. Rahul is not fulfilling first condition. Second B he is fulfilling, because last 4 years he is in India for 368 days, we just calculated. First is also, that is second A is also fulfilled. Rahul will be resident, and according to section 6.6, he will be deemed to be RNOR, resident but not ordinarily resident. RNOR, some people call it as RBNOR. Whether you call it as RBNOR or RNOR is one and the same. Raj, for Raj 182 days. And what is the presence of Raj in India? This condition is fulfilled. 368 days he is present in India in the last 4 years. First condition is not satisfying. Second A also is not satisfying. He is not in India for 182 days. Therefore, Raj will be called as non-resident. Raj non-resident, Rahul resident. Raj and Rahul. Okay. Both of them would be non-resident. Wrong answer. Raj is resident but not ordinarily resident. Rahul is non-resident. Rahul RNOR. Raj non-resident. Wrong. Rahul is resident but not ordinarily resident. Raj is non-resident. This is the correct answer. I hope you are understanding. And last, both of them would be RNOR. This is wrong answer. Correct answer is C. With that, all loose MCQs are also over. Now we are about to start with full-fledged last 10 questions. All 10 of them are big questions. No, not all 10. One or two are small questions as well. There are theory questions also from 16 to 25 and some practical questions also. Question number 16 is on capital gain chapter section 50B, slump sale. Slump sale. This is nothing but reproduction of one of the past exam questions. Question 16 is ditto same as past exam question with some modification to give effect to provisions of Rule 11 UAE. Rule 11 UAE. What is it? Let us understand. So slump sale, what had happened was, in case of slump sale, some amendments were carried out. Some amendments were carried out by Finance Act 2021, but with retrospective effect from AY 21-22. So 50B, slump sale. Now what was happening was, in case of slump sale, you know pretty well, slump sale, indexation benefit is not allowed. Sale consideration, which will be actual sale consideration, minus cost of acquisition plus cost of improvement, and cost of acquisition plus cost of improvement will not be equal to actual cost but will be equal to net worth. Net worth of the undertaking which is transferred, and net worth would mean assets minus liability. Assets minus liability. Differential amount would be long-term or short-term capital gain, LTCG or STCG, depending upon period of holding of the undertaking, of the whole undertaking which is transferred. If the undertaking period of holding is more than 36 months, gain will be long-term. If the period of holding of the undertaking is less than 36 months or up to 36 months, it will be short-term. We know about it. It could be long-term capital gain or long-term capital loss, short-term capital gain or short-term capital loss. Okay. Net worth would mean assets minus liability. Now what has been done by Finance Act 21 is that, what changes have been made? The first change, couple of changes have been made which we already discussed in amendment session as well as in the regular lecture also. The meaning of net worth will remain same. This will be same only. Only one thing is the cost of acquisition of self-generated goodwill. There is no clarification. Cost of acquisition of self-generated goodwill of business or profession will be nil. That is one amendment. Second amendment that is made, which is the major amendment, is that sale consideration up till now used to be the actual sale consideration in 50B. Actual. Now it will no more be actual sale consideration. Instead of actual, sale consideration will be governed by 50B read with Rule 11 UAE. Sale consideration now for the undertaking which is transferred, sale consideration will be higher of the following two. Will be higher of FMV 1, fair market value 1, and FMV 2. FMV 1, FMV 2. And FMV 1 and FMV 2 are to be determined as per Rule 11 UAE. Rule 11 UAE. Rule 11 UAE sub rule 2 for FMV 2, FMV 1, and Rule 11 UAE sub rule 3 for determining FMV 2. Net worth remains same. Sale consideration which was actual always has now been changed. It shall no more be actual sale consideration. It shall be higher of FMV 1, FMV 2. What is FMV 1, FMV 2? We will discuss. But FMV 1 would mean fair market value of assets which are given away. Assets given or assets transferred. And FMV 2 would mean FMV of assets received or money received. What is received could be either money or assets. So FMV 1 means FMV of whatever is given away, and FMV 2 means FMV of whatever is received. Of course, FMV to be determined as per Rule 11 UAE read with Rule 11 U. One may have to contact registered valuer to find out the correct FMV on the date of slump sale. We'll have to find out. Okay, now we have a question based on that. Beta Limited, 16th question. Beta Limited has transferred its unit Omega to Delta Limited. unit omega, underline by way of slump sale. As I stated in the class earlier, while discussing section 50B, it will be given in the question whether you are supposed to apply the provisions of slump sale or not. Institute always clarifies that this is the question on slump sale. If it is not given, then you will have to make up your mind whether one should go for slump sale or itemized sale on 31st December 21. Then balance sheet or the book value should be as on 31st December 2021. Though we prepare balance sheet at the end of the year on 31st March, one will have to prepare balance sheet on 31st December also. Summarize balance sheet as follows. Assets, fixed assets and debtors two category, unit gamma, sigma, omega. Omega is transferred. Debtors gamma, sigma, omega. Omega is transferred. Paid up capital and reserves and surplus do not form part of net worth computation. So for net worth, we will be subtracting assets minus will be subtracting liability of given undertaking omega, 45 lakh. Only three items are given, two types of assets, fixed asset, debtor, and one item on the liability side. This will help us to find out two things. These two minus this. Of course, valuation will change. I'll come to that point. This will help us in calculating two things, net worth also, and the same thing will be required to find out FMV1. FMV1 means FMV of the assets which are given away. And which assets are given away? Unit omega. The omega units assets will have to be valued twice. One for the purpose of finding out net worth of undertaking or unit omega, and one for the purpose of finding FMV1. Formula remains same, assets minus liability, but assets minus liability will have to be found out twice by considering two different types of values for unit omega. Okay, further. Using the further information given below, compute the capital gain arising from slump sale and the tax on such capital gain. If it is long term, tax rate will be 20%. Cost inflation index for financial year 10-11 and 21-22 are 167 and 317. This is irrelevant point because indexation is not allowed otherwise also. Lump sum consideration for transfer was 600 lakhs for unit omega of this company. This is a relevant figure. However, this will be taken into account. Up to AY 2021, the computation under section 50B used to start with 600 lakh. Now 600 lakhs will have to be compared with something called FMV1, which we'll do. That is the new concept. So 600 is not to be ignored, but 600 is to be compared with FMV1. If it is higher than 600, we'll take that amount. Third point, fixed assets of unit omega includes, fixed assets are what amount? Fixed assets are given to us as 275 lakh. Fixed assets include land which was purchased at 30 lakhs, cost of acquisition is 30 lakhs in August 12 and revalued at 45 lakhs on 31st December 2021 as on the date of slump sale. So 30 lakh becomes 45 lakh, increased by 15 lakhs. Stamp duty value of the land as on 31st December 21 is 42 lakh. Okay, so in order to compute net worth, for net worth computation and what amount will be taken into account for FMV1. So for FMV1, for this asset called land, we will take into account the stamp duty value. FMV1 will take stamp duty value 42 lakh, and for net worth computation we will take book value 30 lakhs. Asset is same, but one place we will take 30 lakhs, one place we will take 42 lakhs. Fourth point, other fixed assets. Other fixed assets means, see, there are two assets, debtor and fixed assets. Out of fixed assets of unit omega, 275 is the total fixed asset. Usme se land is removed. Value of the land will be 45 lakhs. So 275 includes 45 lakhs of land. Other assets representing machinery are reflected at 230 lakhs. That is 275 total fixed assets minus value of land 45 lakhs, which represents WDV as per books of machinery. WDV as per Income Tax Act 43 subsection 6, 43 clause 6 as on 31st December 21 is 155 lakh. Again question arises, which value will be taken into account for the purpose of determining net worth, which value will be taken into account for the purpose of determining FMV1 for this asset called machinery. So for net worth we will consider value as per income tax, that is 155 lakh, 155 lakh, and for FMV1 we will take into account latest market value 230 lakhs. Getting this point? Up till AY 2021 we were required to find out only net worth. Now apart from net worth you will be required to find out FMV1 and 2 also. Unit Omega was set up by Beta Limited in May 2010, therefore it will be long term. Therefore it is long term, period of holding is almost 11 years. Company does not opt for section 115BAA. How does that matter? Whether company opts for 115BAA, that is 22% tax rate plus compulsory surcharge 10%. Well, it does not matter. Computation under section 50B does not depend upon this option selected or not selected. Computation of capital gain will remain same. Here it is going to be long term capital gain for a reason. Unit was set up in May 2010. We had underlined somewhere. So what is the relevance of this line? Unit, this company does not opt for 115BAA. The reason is that if company opts for 115BAA, everything will remain same, everything top to bottom. Only thing is there will be compulsory surcharge under 115BAA of 10%. When the question says no 115BAA, that means no compulsory surcharge of 10%. No compulsory surcharge of 10%. Now surcharge will be attracted only if income exceeds 1 crore or income exceeds 10 crore. Assessee is a company, don't forget. Okay, pretty well. What to do? So first find out sale consideration and net worth. Rest all is very simple. So we'll find out FMV1. FMV1 means FMV of the assets given. FMV2 600 lakhs. FMV2 will be 600 lakhs. This because only money is received, assets are not received. Okay, think about it and tell me which value should be taken into account while computing FMV1. For FMV1 also liability will have to be subtracted. We have liabilities. Yes, we have 45 lakhs of liability, trade creditors, for which there is no further clarification, so liability remains 45. Asset value will undergo changes. Help me in computing net worth. Let's finish off net worth. Net worth, three types of assets are there. First is land. Land is to be valued at 30 lakhs. Land 30 lakhs. Other assets are worth, for net worth computation, other assets will be for 155. And we have debtors also 400 lakhs plus 400 lakhs minus liability. Liability remains same. Liability is 45 lakhs minus 45. Quickly calculate 30 plus 155, 185, 185 plus 400, 585, 585 minus 45. 540 lakhs is a net worth. Sale consideration will be higher of FMV1 and FMV2. FMV1, FMV2. FMV2 is 600 lakhs, that is FMV of what is received. Here assets are not received, only money is received, which has its own monetary value, no need to find out the value. FMV1, how to find out? FMV1, which is on the same lines, Rule 11 UAE, again three assets. Debtors will remain same, 400 lakhs, no changes to be made. Land, for FMV1, it will be land. Land will be valued at 42 lakhs stamp duty value. 42 lakhs stamp duty value. Other fixed assets will be valued at market value 230, assuming 230 is FMV. 230. Debtors will remain same, 400 minus liability. Liability is still 45. So FMV1 would mean 42 plus 230, 272, 272 plus 400, 672, 672 minus 45. That is 630 minus 3, 627. 627. FMV1 is 627, FMV2 is 600, Higher of the two is 627. 627 minus net worth is 540. 540. 627 minus 540. 87 lakhs. 87 lakh will be long-term capital gain. 87, isn't it 87? 60 plus 27, 87. 87 is the amount of long-term capital gain. However, you are being asked to compute not only the capital gain, you are being asked to compute tax also. Tax will be how much? 87 lakh into 20% under section 112, read with 50B. 87 into 10 will be 16 plus 1.4. 17 lakh 40,000. 17.4 plus no compulsory surcharge. Surcharge would be attracted only if total income exceeds 1 crore. It's a company. Total income right now we know is only by way of capital gain, which is 87 lakh. We don't know how much is the other income. So by default surcharge would be nil. Plus health and education cess, after taking total, health and education cess will be 4%. At the rate of 4%, how much would that be? So let's just work it out. 17 lakh 40,000 into 1.04. 18,09,600. Total will be 18 lakh. How much was that? Let's just check whether this is one of the option or not. Oh, these are not MCQs. MCQs are over. I just forgot about it. The answer is LTCG 87 lakhs and tax on the same would be 18 lakh 9,600. Let's just check this. 18,09,600. Yes. 17 lakh 40,000 plus health and education says 18 lakh 9,600. Our answer is correct. Even our computation of FMV1 was also correct. Higher of FMV1 and 2 will be 627. FMV1 is 627. FMV2 is 600 lakh. This FMV1, FMV2 I have not introduced. Government has introduced this new concept. Okay, how to calculate FMV1 and 2 that I've given here. This is given in Rule 11 UAE. Okay, A plus B plus C plus D minus L. Formulas are given and brief. Now I've covered summary of Rule 11 UAE subsection 2 and subsection 3 also. Summary is also covered. Have a look at it. Right. So please do the needful. 18,09,600. Are we getting that answer? Yes, 18,096. With that, question 16 comes to an end. Let's proceed further. Let's come to question 17. 17 question is on computation of total income. Computation of total income. However, here assessee is opting for section 115BAB. That is a manufacturing domestic company. Tax rate will be 15%. Compulsory surcharge 10%. Plus health and education says. Regal Private Limited is a company incorporated on 15 December 19. In order to qualify for 115BAB, the company has to be incorporated on or after 1st October 2019. So that condition is fulfilled. And it should start manufacturing latest by, it should be engaged in only manufacturing business. Manufacturing should commence on or before 31st March 2023. Is engaged in manufacture and sale of ceramic tiles. Commenced manufacturing in January 20, all conditions are fulfilled. Correct? Okay. The net profit of the company as per statement of P&L for the year ended 31st March 22 is 220 lakh, but 220 lakh is after debiting crediting following items. Please read the question on your own, then start watching the video. You will have a better understanding. 220 lakh is the net profit, but after debiting crediting. So 1, 2, 3, 4, 5, 6, 7 items and 4 additional information. Total 11 points are given. You have to decide what treatment is to be given. Company is opting for 115BAB. It is given also in the last line. Compute the total income of the company and the tax liability, income plus tax, assuming company has decided to opt for tax regime under 115BAB. Okay. Now, if company opts for 115BAB, then what will happen is, under chapter 6A, it can claim deduction under section 80JJAA. It can claim deduction under 80JJAA. It can claim deduction under 80M and it can claim deduction under 80LA. Barring these three, other chapter 6A deductions not allowed. Secondly, business income, the company is allowed to do only manufacturing business, manufacturing and sale of those items. Business income will be taxed at 15% rate. However, this benefit is not extended to all incomes. Other incomes, what will happen? If other income other than business income is short-term capital gain arising on transfer of asset on which depreciation was not claimed, then will be taxed at 22%. Then if it is IFHP, company can have IFHP income also, IFOS income also, they will also be taxed at 22%, and it can have other incomes also. Other incomes will be taxed at 22%. However, these two incomes other than PGBP income, that is other income, in other income other than short-term capital gain on which depreciation not claimed, other income will be taxed at 22% without any deduction for expenditure. This is the difference, right? Just keep it in your mind. Other than these three, other chapter 6 deductions not allowed, certain PGBP deductions not allowed, only manufacturing business should be there. Other than manufacturing, other business is not allowed, trading business not allowed. Business income taxed at 15%, other incomes would be taxed at 22%, but if rate of tax will be 22 only, unless it's a special income like short-term capital gain covered by section 111A, that will be taxed at 15%, long-term capital gain covered by 112A exceeding 1 lakh will be taxed at 10%. That will remain same. What I am trying to say is that for short-term capital gain 22% after claiming deduction of transfer expense and cost of acquisition. For all other incomes, tax rate 22% but without claiming deduction for expenditure. That is a system. Okay, quickly 220 lakh is after debiting, crediting following items. I am not going to solve this question entirely. I will just be writing the effect of adjustment and explain you. Calculation part you take care by yourself. One-time license fees of 22 lakhs. So 22 lakh is a capital expenditure. It's a one-time license fees. It is already debited or credited to P&L. Paid to ABC Limited Indian company for obtaining franchisee on 1st June 21. So add back 22 lakhs. 22 lakh is a capital expenditure, but depreciation on the same, which is available at the rate of 25%, will be allowed. 25% of, and it is acquired on 1st June 21. License fees is an intangible asset eligible for depreciation. 25% of 22 lakh will be 5.5 lakh. 5.5 lakh will be subtracted, 22 lakh will be added back. First point is done. Second is 32,000 paid to BN company, a goods transport operator in cash on 31st January. This is based on section 40A3. Limit of cash payment in 1 day is 10,000, but if it is paid to transporter, then the limit is 35,000. Amount is 32,000, therefore no effect. Then third, this is interesting. Now this you please focus upon this point. Rent of 60,000 per month into 12 months, that is 7,20,000, receipt from letting out of a part of his office premises. But letting out of the part of the office premise does not make it PGBP income, nor will it go under IFOS. It will be taxable under the IFHP. However, it will go under IFHP, but since company is opting for 115 BAB, the tax rate on this income will be 22% and not 15%. 22% plus compulsory surcharge 10%, however without any deduction. So first of all, 60,000 per month received from letting out a part of its office. Municipal tax paid in respect of the same part of the building is 8,000 proportionately. Same has been debited to statement of P&L. So what you do is that this 8,000 you add back because it is debited to P&L. 8,000 add back. 60,000 per month into 12 months. 7,20,000 you subtract from PGBP head, and then this 7,20,000 will be taken to IFHP. Under the head IFHP, you add 7,20,000 without any deduction. No standard deduction 30%, no municipal tax. Here municipal tax is debited to P&L account, therefore we are adding it back. Therefore 8,000 is added back and 720 is the income credited to P&L. So we are subtracting. Why are we subtracting this and why are we adding this back 8,000? To remove them from PGBP head. And after removing from PGBP, when you take it to IFHP, under the head IFHP you will be adding 7,20,000. No deduction will be claimed because of 115BAB. No expenditure will be allowed. No standard deduction, 30%, no municipal tax. Fourth point, 2 lakh being contribution to scientific R&D, Scientific Research Association approved and notified under 35(1)(2). Section 35(1) clause 2 not allowed, add back 2 lakh rupees, not allowed because opting for 115BAB. Okay, then 5 lakh rupees paid to a contractor for repair work at the company's factory, no tax was deducted. No tax was deducted, then 5 lakh into 30%, 30% will be disallowed. TDS was supposed to be deducted under section 194C for repair work because amount is more than 1 lakh for the whole year. 30% of the same 1,50,000 will be added back. This much will be disallowed under section 40 clause A, subclause 1A, assuming payment is made to resident person. Dividend of 10,000 from Gamma Limited earned on 1,000 equity shares. The 10,000 is already credited to P&L. These items what we are reading are already debited or already credited to P&L. So 10,000 will have to be subtracted and we will shift it to IFOS. So under the head PGBP, less 10,000 and under the head IFOS add 10,000, but this 10,000 will be chargeable to tax under the head IFOS at the rate of 22% without any deduction for any expenditure. Gamma Limited earned on dividend of 10,000 from Gamma Limited earned on 1,000 equity shares of rupees 10 each. Rupees 10 is a face value, but they were purchased at 100 rupee per share. That means 1,000 shares into 100, 1 lakh rupee they were purchased for on 10th October 2017. That means long term. But we don't know whether listed or not listed. These shares were sold on 1st March 22. So now we will have to decide whether they are listed or not listed at 280 per share. Gain on transfer of these shares is credited in the books of accounts. That means credited to P&L. So we'll have to remove it. We will have to reverse the effect. How much has been credited to P&L? To answer difference, 280 rupees is the selling price minus 100 rupees the purchase price. 180 rupees per share, 180 per share into 1,000 shares is equal to 1,80,000 must have been credited. So in PGBP head we will minus 1,80,000. Capital gain head we will consider, but capital gain head mein how much to be added that we don't know because they are long term acquired in 2017 long term shares. So capital gain may have to be computed with indexation or maybe without indexation, we don't know. So right now I am keeping the amount pending. I am keeping it pending. Depreciation on tangible assets, tangible fixed assets. First one was intangible. So 5.5 lakh is a separate depreciation that is on intangible. On other tangible fixed assets as per books of account is 220. As per books of accounts, so we add back, you know about it, 220, and whatever is the depreciation as per Income Tax Act, that much will be subtracted. Now these 7 items which are debited credited to P&L are over. Additional information, depreciation on tangible fixed assets as per income tax rules is 260. So what to do? 260 subtract 260. Depreciation as per books of account we added back, depreciation as per Income Tax Act will be subtracting now. Okay, these are the items which are additional information. These are not already debited or credited. Company has acquired on 15 November 2021, acquired what? Machinery, which is depreciable asset, but acquired on 15 November 21. That means less than 180 days. Depreciation, if at all, will be half, but it is plant machinery, so additional depreciation also could be possible. Normal rate of depreciation is 15%. Instead of 15%, we'll claim half of that, 7.5%. Additional depreciation which is available only on plant machinery at the rate of 20%. Additional depreciation not allowed because 115BAB. Acquired for 20 lakh cost of acquisition and put the same to use on the same date. Depreciation on such machinery is not included in point 1 above. So 260 does not include depreciation on machinery. So now we will claim 20 lakh into 15% into half is equal to 3 lakh divided by 2, 1.5 lakh. 1.5 lakh to be reduced. Additional depreciation not allowed. Additional depreciation not allowed, though allowable otherwise, but since company is opting for 115BAB, therefore additional not allowed. Okay, next is fair market value of shares of Gamma Limited on 31st January 18. Now 31st January 18 का FMV is given to us 110 rupee because to apply concept of grandfathering of cost of acquisition. Well, it is nowhere given. It seems institute has forgotten to clarify in this point also, where we studied about shares. Here also they have forgotten to clarify whether these shares are listed or not listed, but doesn't matter. Acquired for 100 rupee, sold for 280 rupees, FMV was 110 rupee on 31st January 2018. So what will happen is, sale consideration is 2,80,000, that is 280 per share into 100 into 1000 shares. Less cost of acquisition will be higher of the following two, either 1 lakh the actual cost of acquisition or 1,10,000 the FMV on 31st January 18, 110 rupee into 1000 shares. Higher of the two will be 1.10 lakh, you know about it. 1.70 will be LTCG. However, this LTCG will be governed by section 112A. That is the reason we did not take indexation, and that is the reason we consider this 31st January's FMV for grandfathering, which is available only if listed only under section 112A. From 170 out of 1,70,000, first 1 lakh is not taxable, balance 70,000 will be taxable at the rate of 10%. We know about it. Fourth point, on account of expansion of his activities, 180 new employees joined during previous year 21-22. 180 new employees. By reading the word new employees, you should understand they are talking about deduction under section 80JJAA. Is 80JJAA allowable? Answer yes, I already told you. 80JJAA is allowable even if company opts for 115BAB. Employees are divided into 4 categories: 1, 2, 3, 4, 51, 46, 48, 35. Date of employment. Now you know pretty well that 80JJAA is available only if the employees are appointed in the current year for 240 days or more than 240 days. For 240 days or more. If the employee is appointed, the associate company is in the business of manufacturing leather products or leather goods or apparel, then in wearing apparel, then in such situation limit will be 150 days. But here 240 days of limit will be applicable, that is approximately 8 months. So those employees appointed on 1st April 20, let's do filtration, which of the employees not eligible for 80JJAA. 80JJAA is available at the rate of 30% of emoluments paid to new employees. Those appointed on 1st April, date wise filtration, eligible. Those appointed on 1st June, eligible. 1st August, still eligible. 1st September, not eligible. How many months should have been employed? 8 months. So one can afford to lose starting 4 months: April, May, June, July. So if appointed on 1st August, they may be eligible, we'll have to see. But if appointed on 1st September, then those 35 employees definitely not eligible this year, may be eligible next year. Next, regular or contractual. The regular, contractual, regular, that's okay. They should be participating in provident fund. And last condition, last filtration column, emoluments should not exceed 25,000 per month. So 23,000 eligible, 26 not eligible, 27,000 per month not eligible, 24,000 eligible. So technically 46 employees not eligible because of emoluments exceeding 25,000 per month. These 48 employees are also not eligible because of emoluments exceeding 25,000 per month. These 35 employees not eligible because of their date of appointment. So eventually, who is left out? Only those 51 employees who are being paid 23,000 per month. So for the purpose of 80JJAA, we'll have to find out how much will be eligible, what will be the amount. So it will be 51 employees multiplied by 12 months multiplied by 23,000 per month. Whatever may it be, multiplied by 30%, that much will be 80JJAA deduction. That's it. Emoluments are paid by ECS. That this is also one of the conditions for claiming 80JJAA. If paid by cash, then deduction not allowed, or those employees not to be counted. ECS through bank, it may be assumed that employees participate in recognized provident fund, that's okay. So 80JJAA will be available only with regards to first 51 employees. That's it. Compute total income of the company and tax liability, assuming that company opts for concessional tax rate under 115BAB. Nothing great. The only thing which people face difficulties in 80JJAA, that I have explained you properly, People face difficulties with regards to this depreciation. And the most important part is this IFHP income and dividend income. IFHP and dividend income and IFHP, where is IFHP? This third. Whatever points I have put a box on, those are relevant from exam perspective, you need to understand them. Right? Solution is there provided by institute, you can have a look at it and match the answer. Remember, which incomes will be taxable at 22%, 10,000, and capital gain we calculated 1,70,000, 1,70,000. But this capital gain will be taxed not at 22%, first 1 lakh not taxable, balance 70,000 will be taxable at the rate of 10% under section 112A. This you need to remember, no 22%, no 15%, but 10%. IFHP is the most important part. So what I observed amongst my students was that people were goofing up here, that IFHP income they removed from PGBP, they added to IFHP, but in IFHP they claimed standard deduction 30% as well as municipal tax. This is not to be claimed if opting for 115BAB. This kind of rule is not there in 115BAC, BAD or 115BAA, it is there only in 115BAB. Clear about this? So please highlight those points which I have put a box on, point 1, point 3, point 6. Proceeding further, next question is minimum alternate. Next question is on minimum alternate tax, MAT along with Ind AS. Those companies which have started adopting Ind AS. Very easy question. This is replica, or I would say reproduction of one of the past exam questions which we had discussed in the class also. However, Institute has made some minute changes which are not impacting solution. Manav Rachna Limited, Indian company engaged in manufacture and sale of electrical appliances in India and abroad, started adoption of Ind AS with effect from 1st April 20. 1st April 2020, so current year is the second year. You know, why do we need to find out whether which year is it current year? If you recollect, transition amount 1/5 is to be given effect in the first 5 years. Okay. Other comprehensive income OCI, that will not be reclassified to P&L. So anything which is debited to OCI needs to be subtracted from book profit, and anything which is credited to OCI needs to be added to the book profit. This is the rule given in section 115JB subsection 2A, 2A, 2B, 2C. 2A, 2B, 2C. 2C is for transition amount and 2A is for items debited credited to OCI. 2B is applicable in case when there is a demerger resulting company. So right now 2B will not be applicable, 115JB subsection 2A and subsection 2C. Okay, anything which is debited or credited to OCI, other comprehensive income, under the category items that will not be reclassified to P&L. However, excluding two items as per proviso to 115JB subsection 2A, excluding changes in the fair values of equity instrument and excluding revaluation reserve for or revaluation surplus for assets, right, barring these two. So 7.4 lakh and 6.10 lakh, no effect to be given. 2.8 lakh is to be, it is debited to OCI, debited to statement of P&L, debited to you subtract, and deferred gains on cash flow hedges you add, it is credited to P&L. So in book profit you will be adding it back, and remeasurement of post employment benefit obligation, this also you will be adding. Okay, so 7.5, 6.2 to be added, 2.8 to be subtracted, but from where? From book profit. So first you will have to compute book profit. Is there any information given? Answer yes. Following are the other particulars for year ending 31st March 22. Book profit after adjustment of items specified under 115JB subsection 2. After adjustment of all items specified under explanation 1 to section 115JB amounted to 97.54. Book profit is 97.54. In this book profit we will be making these three adjustments, 2.8, 7.5 and 6.2. However, it further says book profit is 97.54 except the adjustment brought forward losses and unabsorbed depreciation for the year ended. Next point is talking about brought forward loss as per books of accounts in lakhs. 1920 and 2021 financial year, business loss 9.10, depreciation 6.4. Business loss 6.10 and 8.10. We know pretty well that we have to compute, we have to claim, company can claim whichever is lower. We actually need to take the total 15.10 and here total will be 14.5. So technically 14.5 should be allowed unless company is the one against whom application for corporate insolvency resolution has been filed. CIRP, corporate insolvency resolution process, has been filed before IBC under IBC Insolvency and Bankruptcy Code. If it is such a company, or it is a company in whose case board of directors are suspended by central government, I mean NCLT, based on recommendations of central government under section 241 of the Companies Act, and new board of directors appointed. Either companies against company application is made under IBC or board of directors are suspended by NCLT, then company can claim deduction for both of them. Let's see what is the position. The transaction amount as on convergence date. Transaction amount we know pretty well, again effect to be given, but transaction amount effect not to be given in one go, effect to be given 1/5 every year. Transaction amount on a convergence date 1/4/2020 stood at 68 lakhs. However, 68 lakhs divided by 5, yani that means 1/5 of 68 lakhs, but credit balance it is. If it is credit balance, then what to do? Anything which is credited, you add back. This needs to be added back to the book profit, but 1/5. But transaction amount shall not include two items: capital reserve 8 lakhs and adjustment of 6 lakhs relating to translation of foreign currency or foreign operation. So 6 lakhs and 8 lakhs are to be removed. So first of all, what we will do is that here we'll start with 68 lakhs. From 68 lakhs, two things to be removed: 8 lakhs and 6 lakhs. 8 lakhs you reduce, 6 lakhs you reduce. Balance will be 54 lakh. And this 54 lakh into 1/5 effect to be given to 10.8 lakh. 10.8 lakh. What to do with this 10.8? It is to be added to the book profit or it is to be subtracted? The answer is 68 was a credit balance. Since it is credit balance, it will have to be added back. So 10.8 to be added to the book profit. D point, National Company Law Tribunal, Mumbai bench has admitted an application under section 7 of the Insolvency and Bankruptcy Code. Superb. This is what we were waiting for. IBC, made by financial creditor against the company for initiation of corporate insolvency resolution process, CIRP. Fantastic. So now company, this will have connectivity with this B point. So now company will be eligible to claim deduction of all the 4 items. Simply company can claim deduction from book profit of 15.10 plus 14.50. Company can claim 29.6. 29.6. This will be deducted from book profit. In fact, this is the only point which was left out in computation of book profit. If you observe point number A, it is saying very clearly book profit is 97.54 after all adjustment, except of adjustment for brought forward losses and unabsorbed depreciation. So technically book profit will drop down to 97.54 minus 15.10 brought forward loss and 14.5 unabsorbed depreciation, 29.6. So first let's calculate this. 97.4 97.54 minus 29.6, 67.94. So technically your book profit is 67.94 lakhs. This is your correct book profit because book profit was computed without giving effect to this adjustment. Now we have given effect. 67.94, sorry, not 97, 94. And in 67.94, you will be subtracting 2.8, you will be adding 7.5, 6.2 and plus you will be adding 1/5 of transaction amount. That's it. It's over. You are required to compute MAT liability for the AY so and so, applying provisions relating to Ind AS compliant companies, assuming that the income tax under normal provision, income tax, directly tax amount is given under normal provision is 12.8 lakh. Now here normal income is not given, straight away tax liability is given to you. So you know you can straight away start calculating. When is the MAT credit available? Says compute tax credit. Tax credit is possible only if amount of MAT is higher than the amount of normal tax. MAT is greater than normal, then MAT credit will arise. Normal is given to you as 12.8. MAT you will be finding out. If MAT is greater, then difference will be MAT credit, which is to be carried forward by company, including period up to which it can carry forward. So it can be carried forward for 15 years. You know about it. Now you can calculate it by yourself. Very simple. 67.94 book profit. Then 4 adjustment. Number 1, subtract 2.8, add to 7.5. Third adjustment, add 6.2. And fourth adjustment is add 10.8. Balance is your net book profit. On that, apply minimum alternate tax rate 15%. Surcharge, I don't think so will come because income is below, looks like below 1 crore. Since below 1 crore, surcharge is next to impossible. Plus health and education cess. Okay, this question is done. Now come to question number 19. I'm sure solution is provided by institute. You can solve it by yourself. 19 is a theory question. Again, based on our latest amendments. Now this question on MAT was not based on latest amendments, but 19 question is based on latest amendments for charitable trust, etc. Examine the correctness of the contention, actions, treatment, etc. of the following. Number A, B and C, 3 points are given. Number A, an institution runs university solely for educational purpose. That means this is on section 1023C, subclause 3AD and subclause 3AE. Now before we proceed further, let me remind you of that amendment. For clause 23C, subclause 3AD, 3AE, 3AD is for educational institution and university and 3AE is for hospital and medical institution. Now up to AY 2021, exemption was possible only if gross receipts did not exceed 1 crore rupees. Gross receipt did not exceed 1 crore. Now the limit of 1 crore is changed to 5 crore, shot up by 5 times if gross receipts do not exceed 5 crore. However, there is a clarification that if the trust is running university also, hospital, education institution also, hospital also, medical institution also, then this limit of 5 crore shall not be applied on each organization or each hospital or each university run by the person. This limit of 5 crore is a combined limit for all the institutions run by person. 5 crore is a limit per person and not per hospital, per school, per college, etc. Institution runs university solely for educational purposes and a hospital and university solely for philanthropic purposes, means for providing services to the society. Both university and hospital are not for profit. Okay, this is one of the condition of 1023C. Gross receipt from the university and hospital during financial year 21-22 are rupees 3 crore each. 3 crore each. 3 crore each into 2, 1 hospital and 1 university. 3 crore, it becomes 6 crore. Sorry, exemption cannot be claimed. 6 crore is more than this limit of 5 crore. So, limit of 5 crore is not for each independent institute. Otherwise, it is very much within. 3 crore is very much within 5 crore. Institution contended that the income of university is eligible for exemption under 1023C subclause 3AD and income from hospital is eligible for 1023C subclause 3AE. Answer: totally wrong. This is a wrong claim. Since aggregate annual receipts in each case does not exceed prescribed threshold limit of 5 crore and there would be no requirement to get approval of higher authority. Answer: totally wrong. They will have to take approval. 1023C subclause 3AD AE will not be possible. It will not be possible to claim exemption under these two. Trust can claim exemption under 1023C. I hope you understood why. They can claim exemption under 1023C subclause 5, subclause 6, subclause 6A, etc. B point. Clear? B. A registered charitable trust, again applicable to trust, registered charitable trust with the main object of relief for poor wants to set off is excess application of 27 lakhs. Excess application is nothing but deficit of earlier years. Now deficit, brought forward deficit of earlier years. Well, amendment has been carried out with effect by Finance Act 21 stating that deficit of earlier years will no more be considered as application of income. So what we generally do, 100 rupees is the income, 15% is exempt, balance 85% we adjust deficit of earlier year. Deficit means last year income was 100, amount applied towards approved object was 105. Then 5 lakh is the deficit of last year, 5 lakh. This 5 lakh of deficit of last year is carried forward to the current year, brought forward to the current year, and in current year it was going to be allowed as application of income. Last year trust spent more than what was required, so that extra amount spent should be allowed in the current year, allowable up to last year, but now no more allowed retrospectively from AY 21-22. Registered charitable trust with the main object of relief for poor wants to set off his excess application of 27 lakh while computing income. Answer: not allowed. First, also the claim is false. This is false. Here also it is false. Not allowed. Third point. Charitable trust, again for charitable trust, registered under 12 AB, borrowed 40 lakhs from State Bank in April 21. I have understood the question. I am sure you also must have. Finance Act 21 carried out an amendment that if anything is spent towards approved object by the trust out of its loan amount or borrowing amount, loan amount or borrowed amount, then that much amount will be considered as application of income in the year in which loan is repaid. Not in the year in which it is spent for the approved object, but in the year in which it is repaid. Okay, for purchase of building for opening school in the rural area for primary education of children in backward areas, that means it is spent for approved object. It spent entire amount for the said purpose and claimed same as application of income in March 22. In March 22, it repaid first installment of 5 lakh. Only 5 lakh will be considered as application of income in the current year 21-22. Remaining 35 lakhs will be allowed as application of 85% of income as and when the loan amount is repaid from the income of future years. This was there earlier also, no? How is it an amendment? Answer: earlier it was based on some Karnataka High Court decision of Janmabhoomi Press Trust 1999. Janmabhoomi Press Trust, Karnataka High Court. Now no need to have that High Court decision. Act is very clear. It is specifically amended and introduced in the Act. Question number 20. Examine the applicability of provisions relating to deduction collection of tax at source and compute the amount of tax to be deducted collected in the following cases for so and so year. 1 and 2, two situations are given to us. Rajesh remitted TDS or TCS. What is to be done? So this is on TDS, TCS. I am writing it down on the right hand side, left hand side corner. Rajesh remitted an amount of 5,80,000 towards maintenance expense of his son pursuing education in University of Australia. I am sure this is a question on TCS under section 206C subsection 1G. Under liberalized remittance scheme of RBI, one can remit up to $2.5 lakh, an amount equivalent to $2.5 lakh. Question is on, but now there will be TCS. TCS could be either 0.5% of the foreign currency acquired in India, purchased in India. Seller will collect. You are buying from foreign exchange dealer, he will collect from you. Or it could be 5%. There is a threshold limit of 7 lakhs applicable. Here at some place 7 lakhs applicable, some place no limit. Here also for 5% also some place 7 lakhs, some place no limit. What is it? You will have to refer to section entirely. Rajesh remitted 5 lakh 80 towards maintenance expense. Okay, he also remitted 7 lakh 80,000 to University of Australia for the purpose of his son's education. So what was 580? 580 is for maintenance, 780 is for education out of loan taken. However, loan is taken from employer. Therefore, this benefit of lower TDS at 0.5% will not be available. 0.5% rate is applicable only if the loan is taken for higher education from any bank or public financial institution. The loan is taken from employer, then that is not eligible. That is not eligible. It will be subjected to 5% rate, but after 7 lakhs, after first 7 lakhs. First 7 lakhs no TCS. An Indian manufacturing company, the employer. Both the remittances were made through same authorized dealer under the liberalized remittance scheme of RBI, LRS. Well, luckily both the transactions are through same authorized dealer, therefore we can merge them. So 580 plus 780 total is 1360. Out of 1360, first 7 lakhs no TCS, first 7 lakh. TCS will be at the rate of 5%. Why 0.5% TCS rate benefit is not available? 0.5% cannot be applied because the loan is taken from employer. It is very clearly stated in 206C1G that the loan should have been from bank or financial institution as referred to in section 80E. 80E. Employer is not covered by 80E, therefore first 7 lakhs benefit will be available, 6.60 will be taxable or will be subjected to TCS as 5%. Are we required to compute the amount of TCS? 5% of 6.6. If asked, you calculate it by yourself. Compute the amount of tax to be deducted, you will have to. So it will be 30,000 plus 3,000, 33,000. 33,000 will be the amount of TCS. Next, Mr. Epi, resident Indian e-commerce participant. 194O, 194-O, you must have understood, or equalization levy, either of them. Mr. Epi, resident Indian, the moment you read resident, equalization levy will be disappearing. Equalization levy is possible only if e-commerce participant and e-commerce operator both are non-resident. Mr. Epi, resident Indian, who is e-commerce participant, that means seller, the vendor, sells goods worth 84 lakhs through e-commerce website High Sale, which is e-commerce operator. That means I am Epi, I am selling through you, you are selling to customer, you are e-commerce operator, you will have to pay me 84 lakhs minus your commission. From this 84 lakh, when you make payment to me, you will have to deduct TDS. Epi has not furnished permanent account number or Aadhaar number. This is TDS under section 194-O. TDS will have to be deducted at the rate of 1%. 1%. E-commerce operator, Mr. Epi has not furnished permanent account number or Aadhaar number. Then it will be 5%. He has furnished his return of income for all the preceding assessment years before the due date of filing the return or before the due date of filing IT return given in 139(1) section. Okay, that means 206AB will not apply. 206AB not applicable if IT returns are filed. 206AA without PAN number, that concept is applicable, but rate in that case becomes 5%. Rate cannot become 20%. With that, question number 20 comes to an end. 21st theory question. ABC Limited domestic company applied for advance ruling on 1st April 21. We know pretty well authority for advance ruling, AAR, you can write down this question is on. AAR existed only up to 31st August 2021. From 1st September 21 onwards, 1st September 2021 onwards, there was Board for Advance Ruling, BAR. And all the cases which were pending before AAR would now be handed over to BAR. You know pretty well, couple of amendments made in Authority for Advance Ruling chapter. When did this happen? R, that is AAR, became BAR on 1st September 21. Prior to that, it was AAR. ABC Limited domestic company applied for advance ruling on 1st April 21 in relation to tax liability arising out of transactions valuing at 110 crore. Then it was eligible to apply. You know, transaction value exceeds 100 crore, then only that person is eligible. Which is proposed to be undertaken by it. Advance ruling was pronounced on 31st August 21. If pronounced on 31st August 21 up to 31st August 21, then it is valid. Is the same binding? Answer, yes, it is binding on ABC Limited, the applicant. Would your answer change if the advance ruling was pronounced on 30th September? Answer, of course, change, because if pronounced on 30th September 21, it must have been pronounced by BAR, Board for Advance Ruling. If it is pronounced on 31st August 21, it must have been pronounced by, ruling must have been given by R, AAR. But now it must have been given by BAR, which is appealable directly to High Court. Within 60 days, delay can be condoned. Would your answer change if the advance ruling was pronounced on 30th September 21? Answer, yes. Then it must have been pronounced by Board for Advance Ruling and not Authority for Advance Ruling. What would be the remedy available? The remedy is to file appeal to High Court, directly High Court, no CIT appeal, no ITAT. Why? Because Board for Advance Ruling and ITAT are of equal level. Therefore, CIT appeal cannot entertain appeal. ITAT being equivalent to AAR, BAR, ITAT also cannot handle the appeal arising out of ruling pronounced by AAR. One will have to go to High Court straight away within 60 days. If it is agreed by advance ruling pronounced on so and so, straight away go to High Court under section 245W. 245W specifically providing for it. Now the next is question 22. 22 is again a theory question. In respect of Mr. Hari, who is engaged in export of fabrics, information is flagged as per the risk management strategy formulated by CBDT for AY 17-18, 18-19, 19-20, 20-21, 4 years. Information is flagged. Now this is based on section 147 to 148, 149, reopening of the case or income escaping assessment. 4 years. Now we know pretty well that earlier cases could be reopened up to 4 years and 6 years from the end of the relevant assessment year. Now the case can be reopened up to only 3 years from the end of the relevant assessment year. But instead of 3 years from the end of assessment year, time limit would be 10 years. If escaped income is in the form of asset and the amount of such escaped income is 50 lakhs or more than 50 lakhs. 50 lakhs or more. Here 4 years are given, 17, 18, 18, 19, 19, 20, 20, 21. Instead of 4 years, case can be ideally be reopened only for 3 years. Instead of 3 years, it could be 10 years if more than 50 lakh in the form of asset. Income escaping assessment for these years aggregate to 42 lakh. That is less than 50 lakh. Therefore, only 3 years time limit will be applicable. This is Hari. In respect of Hari's friend Rajesh, who is engaged in trading of commodities, search was initiated, oh God, under section 132 on April 21. If search is initiated on or after 1st April 21, then assessment of search cases will be covered by section 147 instead of earlier 153 ABCD. 153 ABCD will no more apply if the search is initiated on or after 1st April 21. Okay, but as far as search is concerned, no, then as per explanation and proviso to section 148, compulsorily 3 years. There will be package of last 3 years, case to be reopened compulsorily for last 3 years. Last 3 years immediately preceding the year of search. Search is in financial year 21-22. Last 3 years will be financial year 20-21, 19-20, 18-19. Can the AO issue notice under 148 to Hari and to his friend Rajesh in April 21? Answer yes, of course. Of course, AO can. Notice can be. If so, in respect of which assessment years notice can be issued? The answer, notice in April 21 can be issued for last 3 preceding years, AY 2021, 1920 and 1890. 3 years time limit. Even for Hari also time limit would be 3 years. Even for Hari's friend Rajesh also time limit would be 3 years. 3 years. The only difference is that Hari's friend Rajesh search is conducted, therefore no need to issue show cause notice under section 148A. The new concept which is introduced now, 148A, that procedure not applicable for Rajesh. But opportunity of being heard by issuing show cause notice, OOBH by issuing show cause notice will have to be given to Hari. For Hari, it will be required. Rajesh, not required. Okay, so whether notice can be issued or not? Answer yes. If so, in respect of which assessment years? So it can be issued for 3 assessment years, AY 2021, 1920, 1819. And is it, third part of the question, is it necessary that the opportunity be provided to them? Answer to Hari, yes, opportunity has to be provided under 148A before issuing notice. And for Rajesh, no need to provide such opportunity of being heard. Okay, question number 23, which is on special rates of tax. Special rates of tax. This question is not that important. Rates of tax. Why this question is not that important? Because except of 1 or 2 points, because there are some silly mistakes committed by institute. It seems that the question has a drafting error, okay, which makes your answer go little haywire. What is it? Let's understand. Tax Limited company incorporated in country T. That means it's a foreign company. Foreign company, certain incomes will be taxable as special rate, at special rates, 10%, 20%, etc., 5% also. Otherwise, any income which is not covered by chapter 12 will be taxable at 40% rate. You know about it. Has the following incomes in India during the year ended 31st March 22, compute total income and the tax liability, income as well as tax for AY so and so, assuming that POEM is outside India. Okay, that's okay. POEM is outside India. Fundamentally, it's a foreign company. So, whether POEM is in India or not doesn't matter, except for few incomes. 1, 2, 3, 4, 5, 6, 6 types of incomes are given, and then 2 points to be noted given. Number 1, no DTAA exists between India and country T. Okay. And the second note we'll discuss later. First point, 6 incomes are given. You have to determine whether taxable or not, net of expenditure or before expenditure, and what will be the rate of tax. Number 1, interest of 2,85,000 earned on debentures. This is replica of one of the past exam questions. That time also November 18 or May 18 institute had asked this question. There are 2 extra points given in this question. Rest all is same. I think that question was red limited and blue limited. Interest of 2,85,000 on debentures of 30 lakhs issued on 1st August 21 current year in consideration of providing technical know-how to MNO Limited, an Indian company, for the purpose of business carried out in India. So first of all, there are 2 incomes involved here. Primarily you may feel only interest is the income, but interest is not only the income. This receiving of 30 lakh debenture, 30 lakh worth of debenture, 30 lakh is also one type of income. It is fees for technical service. So it's like I provide you service, you don't pay me my charges, you were to pay me 30 lakhs, instead of paying me 30 lakh, you are issuing me your debentures worth 30 lakhs. So that 30 lakh is FTS, which will be taxable separately, and there is interest on that debenture 2,85,000. So this interest, debentures are not acquired in foreign currency, therefore this interest cannot be taxed at 10% rate or 20% rate. It has to be taxed at the rate of 40% for foreign company, because 20% rate, 10% rate, etc. under section 115A are available only if debentures were acquired in foreign currency. Debentures are not acquired in foreign currency, therefore interest will be taxable at 40% rate. 2,85,000. This FTS is also it is not being clarified whether there was an this FTS 30 lakh rupees in the form of debentures is as per agreement or in pursuance of agreement approved by central government or not. Agreement should be approved. The agreement between the service provider and the service recipient should have been approved by central government, not given. So institute says assume that agreement is not there or agreement is not approved by central government. Therefore, FTS 30 lakhs cannot be taxed at 10% rate under section 115A subsection 1 clause B. Therefore, it will be taxed at the rate of 40%. FTS also 40, interest also 40%. First income is done. Second income, dividend of 6 lakhs 50 on Global Depository Receipt GDR of YL Limited, Indian company, issued under a scheme of central government against the initial issue of shares of the company and purchased by Trex in foreign currency through an approved intermediary. The GDRs are acquired in foreign currency, all conditions fulfilled. There is only one condition, that GDRs should have been acquired in foreign currency. 650 dividend would be taxed at the rate of 10% under section 115 AC. 115 AC, 10%. Dividend of 15,50,000 earned on equity shares of Indian company. Now these are the dividends earned on equity shares. These are the dividends earned on GDR. As far as GDRs are concerned, GDRs and shares are technically same, but on paper they are different. If the dividend is on GDR, it will be taxed under section 115 AC at the rate of 10%, provided acquired in foreign currency. But as far as equity shares dividend is concerned, there is no such condition with regards to acquisition in foreign currency. Whether acquired in foreign currency or not makes no difference. They will be taxed at the rate of 20% under section 115A, subsection 1 clause A. Special rates of tax chapter, very first section, if you remember in my notes. Point 2 and point 3, both of them are dividend, but one is from GDR, therefore 10%, one is from equity shares, therefore 20%. Fourth, income by way of royalty amounting to 1256,470. Now this I am highlighting, fourth point. Reason, institute has applied one very stupid assumption. I would not call it as a stupid assumption, it's a drafting error in the question. Institute forgot to clarify that this 1256,470 is net of TDS. Then in the solution they are assuming it is net of TDS. Income by way of royalty, then it should be taxed at the rate of 10% under section 115A subsection 1 clause B. Receipt from Z Limited, Indian company, in pursuance of agreement approved by central government. So here agreement is approved by central government. In point number 1, there was no such agreement approved by central government. Therefore, FTS we offered at 40% rate. Correct? Okay. This 1256,470, institute has assumed that this is net of TDS. Tax rate should have been 10% plus surcharge 4%, the effective rate 10.4%. And if you observe, the total income does not seem to be exceeding 1 crore. So surcharge should ideally be nil. So institute has assumed that this is reflecting 89 what percent? 89.6%. If this is 89.6% net of TDS, then how much will be 100%? Because what will be taxable will be 100%. Institute should not have applied such assumption. If they are applying that same assumption, if institute says that by default it is net of TDS, going by that way, each and every previous income should also be assumed to be net of TDS. Why not? So institute has somewhere has committed this error unknowingly, accidental error. Fifth point, business income 850 from unit established in Delhi. It is business income definitely taxable at 40%. 40% tax rate is given in Finance Act. Long-term capital gain of 1,32,000 on transfer of unlisted shares. Unlisted shares compulsorily 10% without indexation. Long-term capital gain 10% without indexation under section 112 subsection 1 clause C subclause 3. This we had discussed in a chapter called special rates of tax as well as in a chapter called special provisions for stock market transactions. In case you have studied under me or you have studied from my notes. Long-term capital gain of 1,32,000 taxable at 10% but computed with indexation benefit. Now here indexation is not allowed. With indexation it is 132, so that amount we are rejecting. Without indexation, capital gain would be 232. 232 will be taken into account. This will be taxed at 10% under section, I repeat, 112 subsection 1 clause C subclause 3. No DTAA exists. Unit in Delhi is not involved in any manner in the provision of technical knowledge or royalty, technical know-how or royalty. Okay, so unit in Delhi, okay, here it matters. Unit in Delhi, if the unit in Delhi was involved in any manner in providing technical know-how or royalty, still it wouldn't make a difference. Tax rate would still be 40% on business income. Okay, you can take the total, which incomes at what rate, that I have clarified here. Solution is there with you, you know how to solve this. Okay, I am picking up 25th question first. 25th I am doing right now, 24th I will pick up in some time. Divakar is a resident of contracting state. This is on tax treaty chapter or DTAA chapter. This is on dual residency. Question on dual residency. So we apply tiebreaker rule. Tiebreaker rule, if individual turns out to be resident of both the country, tiebreaker rule given in Article 4. Para 1. Divakar, resident of the contracting state, namely India and country Y. Resident of the contracting states, namely India and country Y both, as per domestic law. Would it be necessary to apply tiebreaker rule in case of Mr. Divakar? Of course, yes. What institute is asking? Don't make us feel ashamed of our beloved institute. If yes, explain the manner of determining residential status as per UN model. Whether it is UN model or OECD model, it doesn't matter. Both the model conventions have the same rule exactly. 4 points. Number 1, residential status of a person being individual or residential status of an individual who turns out to be resident of both the states as per domestic law will be decided as per rules given in para 4.1. Number 1, he will be deemed to be resident of that country in which he has a permanent home available. If permanent home is available in both the countries, then center of vital interest. He will be deemed to be resident of that country with which his personal and economic relationship is closer. However, if center of vital interest cannot be found out, cannot be worked out, or he does not have permanent home in either of the states, then he will be deemed to be resident of that country in which he has a habitual abode. Habitual abode means the country where he stays. Permanent home or personal and economic relationship, habitual abode. If he has a habitual abode in both the countries or none of them, then he will be deemed to be resident of that country of which he is a national. If he is national also of both the countries or none of the countries, then his residential status will be decided as per mutual agreement procedure. Okay, 25th question. This question, same question was asked in exam also. There is nothing new. If you observe, last few questions were based on international taxation. Okay. Our last few questions were based on international taxation. Now we will be discussing question number 24. 24th is on DTAA. It's an easy question. There is nothing great here. DTAA you can write down. So in this question, assessee is Mr. Ganesh. Ganesh, a resident individual aged 52 years. Please underline 52 years. That means he is non-senior citizen. He has furnished the following details of his income earned during previous year 21-22. Number 1, income from India. Number 1, income from sole proprietary business. I would suggest that before you solve or before you watch this video, please read the question by yourself slowly twice and then you start watching the video. You'll have a better understanding. Income from sole proprietary business 80 lakhs. This is PGBP income assuming it is already computed net of all expenses. Share of profit from partnership firm. Now share of profit from partnership firm is exempt under section 10 clause 2A. So this is not going to be taxable. Then we have income from country G, agricultural income. Now agricultural income from a foreign country is certainly taxable. Gross. Now there is no need to give it as gross because there are no expenditure given in the question. I have already read the question. CGD, that is country G dollars 40,000 from Tea Gardens, taxable at 20% rate. Underline 20%. Rate of currency conversion is given down the line, which we will take into account. This income is going to be taxable, third income. Fourth income is brought forward business loss. Brought forward business loss, we have PGBP income in India and we have brought forward loss from country G for financial year 18-19, which is allowed to be carried forward for 8 years as per Indian taxation law. 8 years have not yet expired. Loss in country G, CGD 5,200, which is not permitted to be set off against any income as per the law of that country. Agreed, in that country it may not be allowed, but in India if it is allowed, then you have to claim set off. In India this will be allowed to be set off against PGBP income in India. We know about it. Please watch my lectures in detail in case you have not, or you can subscribe for my crash course lectures, that is fast track batch. You can have a better understanding of DTAA provisions. Okay, so 2 incomes from India, one of them is exempt, 2 incomes from country G, and we have one more country, country M, 5th and 6th income, dividend income, which is under income from other source, gross, CMD 30,000, that is country M dollars, taxable at 10% however. Next is rental income. Now this is going to be taxed under the head income from other source, and then we have rental income, that is mostly it will be IFHP if it is from immovable property. CMD, that is country M dollar 52,000 from house property, taxable at 15% rate. This was taxable dividend at 10%. So in country G we had only one particular rate 20%, but in country M we have got 2 different incomes taxable at 2 different rates, 10% and 15%. He paid 6,000 CMD towards municipal taxes in country M. We know pretty well that in India municipal taxes are allowed to be deducted under the head house property provided paid by owner, paid by landlord. Municipal taxes are not allowed as a deduction in country M. Agreed, in that country it may not be allowed, but in India if it is allowed, then we have to claim it. Similarly, in country G there was a loss, business loss, and in country M there is IFHP municipal tax. Both of them are not allowed as a deduction in their respective countries, but in India they are allowed, so we have to claim it. Okay, so this we had discussed at length. There is nothing new in this question. It's very simple. Only thing is that in country M there are 2 different rates, 10% and 15%. So we will have to average it out for the purpose of claiming relief under section 91. Other information, Mr. Ganesh has deposited 1,50,000 in PPF. This will be eligible for deduction under section 80C primarily against Indian income, and if Indian income is not sufficient, then only you will be claiming it against foreign income. Indian income, why Indian income? That is more beneficial. You know about it. We have solved this. We have discussed this at length with examples in the class, in the regular lectures. Any paid medical insurance premium of 28,000 by account pay check. If it is paid by cash, it is not allowed. And on the health, to ensure the health of himself and his wife 48 years. First line, if you see, Ganesh is 52 years of age and wife is 48 years of age. That means none of them are senior citizen. Limit will be, deduction would be under section 80D, but limit will be 25,000 and not 50,000. India has no DTAA with country G and M. Session is about to come to an end. Compute total income and the tax liability. 2 things are to be computed naturally. You know about it. For AY 20 to 23, after providing for deduction under section 91, that is relief under section 91, assuming that one country G dollar and one country M dollar is 70 rupees, assuming all throughout the year. Mr. Ganesh is not opting for 115BAC. This we had discussed in fast track batch also and in regular batch also. If this sentence is not given to you that Ganesh is opting for 115BAC or not opting for 115BAC, if it is not given to you, then depending on the marks of the question, you have to solve the question twice. Once as per 115BAC and number 2 as per normal provisions ignoring 115BAC. But here they have given clearly. Of course it will be given. But if it is for 5 marks or something and it is not given, not clarified in the question, then you write your assumption and proceed further. Okay, if you observe, there are 2 incomes from India, one taxable, one exempt, 2 incomes from country G and 2 incomes from country M. How to attempt such kind of question? So you know pretty well, I told you in the regular lecture also that this kind of question you will have to solve twice. Number 1, first you will prepare working note, of course after leaving space for main answer. You will be preparing working note, one working note whereby income will be computed country wise. How much is the income from India, how much from country G, how much from country M, and second will be your main computation. In main computation you will compute income head wise. First start with salary, then IFHP, PGBP, capital gain, so on. Country wise and head wise. Why do we need country wise? In order to claim relief under section 91, because the amount of relief under section 91 will depend upon how much is the income from given country which is getting taxed twice, doubly taxed income. Okay, so where to start with? So question number 24, you will start from one by one. Income from India, all the 3 countries have 2 incomes. PGBP income, how much was the PGBP income if you recollect? PGBP income from India was 80 lakhs and 20 lakhs is exempt, 80 and 20. So 80 lakhs is the PGBP income. Share of profit from partnership firm nil because it is exempt under 10(2)(a). Total income from India is 80 lakh. Country G. Country G we have got agricultural income which is 40,000. 40,000 into 70 rupee per dollar, it will be 28 lakhs. And then brought forward loss. Brought forward loss, it's a PGBP loss. It is going to be set up against Indian PGBP income. However, while computing working note, when you are computing country wise, you will be setting off this 4th point against this income because you are solving country wise. In the main computation, this loss will be set off against PGBP income, but in the working note, it will be set off against this. 5,200 into 70 rupee per dollar, it will be 33 lakh 50,000 plus 14, 3 lakh 64,000. 28 lakhs and 3 lakh 64,000. 28 lakhs is a positive income, agricultural income, and 3 lakh 64,000 is the loss. I am setting off the loss right here. Working note, what to write that you know pretty well. 28 lakh minus 3 lakh 64,000, that will be 24 lakh 36,000. 24, 36, 25, 28, correct. 24, 36, and last country M. From country M we have got 2 incomes. Dividend income $30,000 into 70 rupees per dollar, it will be 21 lakh. And then 52,000 rental income. However, this will have to compute because here in rental income what is given is rental income. In the absence of fair rent and municipal valuation etc., $52,000 will be considered as GAV. From GAV we will subtract this $6,000 as municipal tax, balance will be NAV, and from NAV we will consider 30% standard deduction because he is not opting for 115BAC. Even if he would have opted for 115BAC, standard deduction would have been allowable. Standard deduction is allowable under IFHP even if opting for 115BAC. Standard deduction under salary chapter is not allowed, here it is allowed. So 52,000 into 70 rupee per dollar, it will be 35 lakh plus 20 to 1 lakh 40, 36 lakhs 40,000, 3640, and this 6,000 municipal tax into 70 would be 4 lakh 20,000. 4 lakh 20 I am putting in bracket, 3640, just confirm, 5 lakh, 35 lakh, 20,000, 1 lakh 40, 36 lakhs 40, correct. So here we have 2 incomes from country M. Dividend income is how much? 21 lakh. 21 lakh. I am considering everything in Indian rupees so that there is a simplicity in calculation. And IFHP income is GAV is gross annual value will be 36 lakhs 40,000, 3640 less municipal tax municipal tax is 4 lakh 20, balance will be 32 lakh 20, and from 32 lakh 20 you will subtract 30% standard deduction, which will be 30% of 32 lakh 20,000. It will be 9 lakh plus 60,000 plus 6,000, 9 lakh 66,000, and 9 lakh 66,000 if you subtract, it will be 23 minus 46, 22 lakh 54,000, 22 lakh 54,000. Just wait for the moment, confirm, calculated. 2254 plus 21, it will become 43.54. 43.54. Take a moment's time, recalculate all the three incomes and have a look at it. 80 lakh is the Indian income, and now we are going to prepare computation of total income. Indian income is 80 lakhs, country G income is 24 lakh 36,000, and country M income is 43 lakh 44,000. Just have a look at it, calculate it again. Okay, now what should we do? Now we should proceed further with the computation of total income. Now here in computation of total income we'll go headwise. First we'll start with IFHP, though it is from country M, I'm writing in bracket. IFHP income is 22 lakh 54,000. We just calculated out. Straight away outer column 2254. PGBP income from India, this is from India, 80 lakhs. This is from India, and loss is from country G. Country G, how much is the loss? 3 lakh 64,000. 3 lakh 64,000 is the loss that you will be subtracting. It is allowed within 8 years, and financial year 18-19 or EVA 18-19 ka loss it was, which is very much within financial year 18-19, which is very much within 8-year period. Okay, so minus 364, that will be 76.36. Will it be 77? Yes. And then finally income from other source. So total 6 incomes are there. One of the income is exempt, so 5 incomes will appear in this computation. Agricultural income is from country G, 28 lakhs. 28 lakhs, and dividend income is from country M, 21 lakhs, totaling to 49 lakh. 21 lakh. So totaling to 49 lakh. 49 plus 76.36 plus 22.54, you can calculate it out. 22.54 plus 76.36 plus 49. 147.9. GTI will be 147.9 lakh. Minus we have got some chapter 6A deduction. Chapter 6A deduction we have got under ATC and ATD. ATC is PPF, 1,50,000 fully will be allowed, and ATD mediclaim premium paid by account pay check 28,000, but only 25 will be allowed. So 1.75 lakh is going to be allowed as a chapter 6A deduction. Balance will be 0.15, and this will be 146. 146 lakhs 15,000. Now 146 lakhs 15,000 is our NTI. Now next step is you compute tax on 146.15. Now since the income is more than 1 crore, there will be surcharge also. He is not opting for 115 BAC, therefore tax will be computed as per regular provision. How much will be the tax? Tax will be, first 10 lakh rupees will be 1,12,500. He is 52 years of age. So how much is it? 146.15 minus 10 lakhs. First 10 lakhs we know the tax. 1 crore 36 lakhs 15,000 into 30%. 40 lakh 84,500 plus on the first 10 lakh we have 1,12,500. Tax will be 4197. 41 lakh 97,000. 41 lakh 97,000 I am writing it in entirety plus surcharge. Now income is more than 1 crore, but it is up to 2 crore, therefore surcharge will be at the rate of 15% of this. 15% of this would be this into 0.15. 629,550. 629,550. Now onwards you know about it. Then also there is some one tricky point. 629,550 plus 4197. This will be 4826,550. 4826,550. You can fast forward in case you are done with the calculating part. Plus health and education cess at the rate of 4%. I am straight away writing the total just to save the time. 4826,550 into 1.04, that is including health and education sales. 50 lakh 19,612. 50 lakh 19,612. Now what do we next? We don't need to round this off. We can round it off. Technically we are supposed to round off the tax to nearest multiple of 10 rupee, but right now will not be. Now we need average rate of tax. Average rate of tax in India would mean tax 15 19 612 50 19 612 divided by NTI. NTI is how much? Net taxable income is 146 lakhs 15,000. 1 crore 46 lakhs 15,000 into 100. Now this will give us some tax rate. How much will that be? This divided by 146 15,000 into 100. 34.35. I'm rounding it off. 34.3456. Let's keep it 3456. 34.3456%. This is the average rate of tax in India. Now what is the average rate of tax in country M and country G? So first we have country G. So actually 34.3456 we should have written here. 34.3456. Either this or the tax rate in country G. Country G, there is only one tax rate. How much is that? Tax rate is 20%. How much was that? Yes, 20%. Country G tax rate is 20%. So for country G, I am writing it as A. Lower of Indian tax rate and country G rate will be 20%. Therefore, relief will be with regards to income from country G under section 91. How much is the income from country G? Now do you understand why do we need this working note which we prepared? Country G income is 24,36,000 doubly taxed income. Chapter 6A deduction, ATC and ATD both are allowed against Indian income. Therefore, nothing is allowable against income from country G or country M. Income from country G is 24,36,000 into 20%. Relief with regards to this country 24,36,000. 24,36,000 into 0.2. 4,87,200. 487,200. We can write it in inner column also and then claim the total relief separately. Number B, relief with regards to or credit with regards to income from country M. Now in country M we have got two different rates. One of the income is taxable at 10% rate. We had marked it down here 10%. Another income is taxable at 15% rate. So here we cannot just simply take an average rate. We can't compute separately. So what we'll have to do, because income amount is different, $30,000 for dividend income and rental income is different amount, 52,000. Now in country M, entire 52,000 must have been taxed under the head income from house property in that country. 15% must have been applied on entire 52,000. However, in India we have considered deduction of the 6,000 municipal tax also. But in that country, municipal tax is not allowed. Therefore, income to be taken into account from country M will be dividend full 30,000 into 70 rupees 21 lakh, and tax on that will be at the rate of 10%. At the rate of 10% tax will be $3,000. 3,000, and from this IFHP income $52,000 is the income into 70 rupees 52,000, or we can simply say tax on this 52,000 at the rate of 15% would have been 5,200 plus 2,600, $7,800. So average rate would be in country M $3,000, 3,000 country M dollars plus 7,800 country M dollars divided by 82,000 CMD. Why 82,000? 30,000 dividend, 52,000 entirely. 30,000 plus 52,000. IFHP we will consider full 52,000 and not 52 minus 6, because as per law of that country 6,000 not allowed. So understand what are we calculating? We are calculating on what amount tax must have been paid in that country. So in that country tax must have been paid on 52,000. So average rate on an average into 100 average. So that means it is $10,800 divided by $82,000 into 100. How much would that be? So we'll have to calculate it out. 10,800 divided by 82,000. 13.1707. Average rate in that country is 13.1707. So which one will be lower? Lower of the two. Lower of Indian tax rate, which is 34.35, and this rate is 13.1707. So this will be lower. So we'll consider this. So relief with regards to income from country M would be, relief under section 91 would be country M income. Now we will consider income from country M to be net of municipal tax and standard deduction, 43,54,000. This particular income, 43,54,000. 43,54,000 multiplied by 13.1707%, relief would be, you can check the answer, this divided by 100 multiplied by, how much was the income? 4354 multiplied by 43,54,000, 5,73,454, and this you can round off, 573,454. 573,454. I am ending the solution here only. With that, RTP is over. You can take the total. Now I am sure you are not meeting me here on the video for calculation purpose. Calculation you can do by yourself. 487,200 from country G and 573,454 from country M. You can take the total, do the needful, balance amount, round up to the nearest multiple of 10 rupee. With that, this RTP comes to an end. Thank you very much. Wish you all a very good luck for your exam.